In New York City, I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help investors make smarter decisions for their portfolios. We're tracking early session volume while bringing you today's top market themes and elevating Yahoo Finance's most popular newsletter.
We've got a lot of ground to cover this Wednesday, kind of Thursday morning. Stock futures moving higher after another negative day for all three major averages. But despite the recent pullback, Wall Street is still bullish. The Dow, the Nasdaq, and the S&P 500 still on track for monthly gains to end the quarter during this abbreviated trading week.
And plus, it's meme stock mania. Big moves from GameStop, Reddit, and Donald Trump's Truth Social. The latest sign of a risk on markets. Let's get right to it. The three things that you need to know. Your roadmap for the trading day. Yahoo Finance's Jared Blikre, Madison Mills, and Rick Newman have more.
Stocks look to mount a rebound. That's after reversing gains late on Tuesday. The S&P 500 hits its third straight loss Wednesday, but Wall Street remains bullish. Stocks in the benchmark index, including Netflix and Disney, they both hit new 52-week highs. And meme stocks, they are back in the spotlight as investors react to GameStop's disappointing earnings and Donald Trump taking his social media company public on Tuesday.
And recovery efforts are suspended following the collapse of the Francis Scott Key Bridge in Baltimore. Officials said the 6 construction workers who were working on that bridge at the time of the incident have been missing too long for hope for rescue. The collapse of the bridge continues to impact shipping companies that are now scrambling to move cargo since that collapse blocked the only route to the port of Baltimore. Shares of coal companies shipping through the port of Baltimore are looking to reverse yesterday's losses.
And Chinese President Xi Jinping meets with U.S. business leaders in Beijing. Xi is looking to mend ties and reassure foreign investors over the country's new trade regulations by speaking to CEOs from Blackstone, FedEx, Pfizer, and Qualcomm. China's motives are clear: to boost growth of the world's second largest economy after foreign investment shrank 8% in 2023.
Now let's get started by setting you up with the market action to get you ready for the trading day here. Kicking it off with a check on the futures here. Just going to do one massive swipe to the bottom. Hoped that it was going to scroll all the way, but hey, take a look. Yeah, a couple swipes here. Dow futures right now, they are looking higher by about 0.4% here. You're also taking a look at the Nasdaq 100 futures, the tech-heavy composite. You're seeing the Nasdaq 100 point higher by about 0.5%. S&P 500 pointing higher by about 0.5% as well. And then just briefly checking in on some of the yields as well. We scrolled past those. We'll just get back up to the 10, the 5, 10, and 30, seeing some slippage across the board there right now, Shauna.
Yeah, Brad, and if you hit the trending list there, we're going to take a look at some of those meme stock trades because they have really come back into favor, at least initially. GameStop selling off on the heels of its earnings results yesterday. But take a look at that top name there, Trump Media and Technology Group, ticker symbol DJT, popped in yesterday's first day of trading under DJT, moving to the upside once again today. In extended trading, we're up just about 21%. If we take a look at the heat map as well and some of the other movers that we have seen, we want to call out moves that we've seen in Disney and also in Netflix. So taking a look inside the Dow, some of those names here. Disney right around a 52-week high. If we can find it, Brad's helping me out there. You see it trading just around $119 a share. Wall Street getting more constructive, a bit more bullish on this name. We had Barclays upgrading the stock earlier this week. Also a number of analysts upping their price targets for Disney, UBS, Raymond James among that name. And then as we search for Netflix, that's another name that we want to keep on your radar here today, just trading right around its 52-week high. And there's so many names right here on the board. But as you can see, certainly a mixed picture here for many of those NASDAQ names. And when it comes to some of those larger cap tech names, many of those moving to the upside here in today's early action ahead of the open.
We're going to save it here. Streaming, there you go. We've got Netflix here. That's much easier to find.
Pull through for me. There we go. Right before the bell, up just about 0.1%. Well, a resilient consumer and strong labor market are largely credited for helping the U.S. avoid a recession so far. Our next guest saying that the strong jobs market is the, quote, key to an upbeat macroeconomic narrative. And in a new call out today, he's raising his U.S. growth forecast for the year by a full percentage point. Joining us now on that call, we want to bring in Paul Grunwald. He is S&P Global Ratings Global Chief Economist. Paul, it's great to have you here at the desk with us. So talk to us just about why you're a bit more optimistic, at least when it comes to growth here in the U.S.
Yeah, the U.S. is really outperforming the rest of the advanced countries. So last year, on average, growth in those countries fell by 2.5 percentage points, actually picked up in the U.S. So we're seeing a boost in productivity. We're also seeing a boost in investment. So the Inflation Reduction Act, which is the government's kind of energy transition push, is crowding in private investment. So all this is kind of lifting the growth profile in the U.S. On top of that, you get strong services and labor market, and we're going to have another year of 2.5% growth this year, it looks like.
What does that do for the view on policy rates from your perspective as well?
Yeah, well, we've always been in the kind of higher for longer camp, and now it's a slower for longer camp. The markets, as we know, keep kind of pushing and hoping that it happens faster. At one point, I think the market had 6 rate cuts priced in for this year. Powell's been very clear. Christine Lagarde at the ECB has been very clear. They're going to be patient and make sure that we're down on a path toward 2. We think the Fed goes with the first cut around the middle of the year, maybe 3 cuts this year. But I think what's emerging is that they may not go as far as we've been thinking, because the neutral rates, kind of the ultimate landing rate, may have gone up. Pre-COVID in the U.S., that was 2.5. Now we think it's closer to 3. And then in Europe, it was 1.5. Now it's 2.5. So this kind of global interest rate, or the global equilibrium interest rate, if you will, has ratcheted up.
So then what does that tell us for cuts then in 2025?
Yeah, well, we get 3 this year and maybe 5 next year. But if we kind of land 3-ish, then we're close to done. Unless the if the labor market tanks, that's the downside scenario. Then the Fed has a lot of space to cut. Now they would do that, but in the baseline, it's going to be gradual, and as we get inflation back to 2.
And there would have to be a reason for 5 cuts to come next year as well. What is the severity of perhaps some of the impact to the economy that you're anticipating in that 5-cut call for 2025?
Right. Well, the U.S. has to slow down, right? If you think this is a 2% economy, and we got to take a little bit of demand pressure out to get inflation down to the 2% target, we're not going below 2, right? Last year, every quarter printed above 2. Looks like Q1's going to print above 2. So at some point, and this is actually our forecast, second half of this year, we've got to slow down a bit. The Fed doesn't have to wait for inflation to get to 2 to start cutting, right? So financial conditions are relatively tight now. When they've got the clear path to 2, then they're going to start gradually, taking the tightness out of the system.
Well, why do you think it's been so tough to get inflation under control? We talk about that last mile flight. Maybe it is higher than what the Fed's target is, just around 2% here. We talk about all the changes that have happened within the economy, but why has it been as sticky as it has been up until this point?
It's a little bit of a mystery, right? If you told, well, by the way, the Fed moved off of 0 about 2 years ago on St. Patrick's Day in 2022, and then they haven't moved since last May, right? So it's really been the labor market. The labor market's a big surprise. If you asked most economists 2 years ago, where would we be if the Fed went, 525 basis points off of 0? No one would be calling for a 3.9% unemployment rate and growth above 2 for the whole year. So we've just had this resilience, which is surprising and good in a way, right? We've still got something close to full employment, but that's what's been so tough. It's the core services inflation that's really the issue here.
What's the core knock to that resiliency, the key that you're tracking to see whether or not consumers do start to show larger cracks?
Yeah, we're watching the labor market very, very closely, right? And particularly the services. That's the key to the whole story.
S&P Global's Paul Grunwald. Paul, great to see you here in studio with us.
My pleasure, guys.
Appreciate it. Well, shipping companies scrambling for a plan B after a container ship struck a Baltimore bridge on Tuesday, blocking the only route to one of the busiest ports in the country. Flexport, a freight forwarder that coordinates shipping logistics for companies, had some cargo on that fateful container ship. To break down what the collapse means for supply lines, Ryan Peterson, who's the Flexport founder and CEO, is here. Ryan, thanks so much for taking the time. We know it's an extremely busy time for you, for the team, anybody who's coordinating efforts around recovery right now. What is the first thought that went through your head? What are you navigating right now at this instant?
Yeah. Hey, great. Thanks. Good morning. Thanks for having me on. Obviously, the first thought is about the rescue workers that are out there and some of the lives that were lost and really the heroic action to save people. We're working overtime right now on behalf of our customers to figure out what to do about their cargo. We have a few containers that are on the ship, just 2 actually. Both of them are exports for flexport.org that are headed to Africa. So for nonprofit organizations. So working with those customers to let them know, they're probably not going to get that cargo back for the next few months. We had 44 containers on the Ever Given, if you remember that ship that got stuck in the Suez Canal a few years ago. those customers didn't get their cargo for almost a year as it sat in sort of litigation limbo with the insurance companies. And so working on contingency plans with those customers. We also have more than 800 containers bound for Baltimore, the port of Baltimore right now. And we're working with the ocean carriers to figure out where those are going to get dropped off. We think most of them will be unloaded in Norfolk, Virginia, and will then need to get trucked or railed to their final destination. So a lot of extra coordination that goes into that in terms of arranging those trucking services, customs clearances, et cetera. So it's kind of a scramble to work on behalf of the customers right now is the main thing that's happening across the shipping industry, really.
Ryan, what does the ability look like when you take into account the ports here in New York, New Jersey, down south in Virginia, the ability to take on even more cargo volume? What does that look like? And as you're trying to navigate this very uncertain environment right now, what does that then longer term, do you think, supply disruption potentially look like here, given the fact that this port has been suspended indefinitely?
Yeah, well, it'll depend on how long this lasts. It's going to take many years probably to rebuild that bridge, several years. I wouldn't want to speak to that, but I suspect they'll be able to open the channel and allow the port to reconnect with the global ocean in a matter of weeks or months. The salvage companies that get in there, they kind of work miracles from my perspective. So I suspect they'll be able to start moving some of that rubble out of the way and get the channel reopened. The ports are probably in an okay position on the East Coast. What's happened this year, because we've had so much disruption to the shipping main trade lanes, starting with the Red Sea, with the missiles that have been hitting these ships in the Red Sea. Well, that's the primary route by which container ships move from Asia to the East Coast of the United States, and that's been disrupted. They're going around the Cape of Good Hope. It takes a lot longer. We also have a congestion at the Panama Canal, where it's only operating at about 2/3 of its capacity. And that's the secondary route by which container ships arrive on the East Coast. So a lot of volume has already shifted from the East Coast to the West Coast as a result of those two factors. And then there's a third one that's coming up in September 31st of this year. The ILA, that's the labor union that operates the ports on the East Coast. Their union contract expires on September 31st of this year. And so there's a lot of uncertainty about whether there will be slowdowns or even a strike at the end of the year. And that has a lot of companies worried about shipping to the East Coast and have started to kind of proactively shift volumes where they can to the West Coast and then say, hey, we'll just bring it across the country by rail or by truck, which costs more but avoids some of that uncertainty. So I think this Baltimore situation is just going to compound that. It's going to cause more companies to shift to the West Coast. It does cost more, but it's faster and more reliable. And so because of that, there is probably enough capacity in Norfolk and New York and even in Philadelphia to pick up the slack from Baltimore. But I don't know, it's a lot of volume to move overnight. And hopefully those ports are ready to staff up and have the union workers and the trucks and everything else that goes into it to meet the demand. We've seen during COVID in 2021 and 2022, where you had all that congestion on the West Coast, that an increase of 10 or 20% of container volume can kind of cause the entire system to grind to a halt. And so we're hoping that we're able to handle this capacity and keep the cargo flowing.
Ryan, all these things accounted for redirection that you're talking about, labor disputes and negotiations that could be coming forward as well. What type of cost are you anticipating could be increased in terms of the comparison to the existing expense profile that you have?
Yeah, I mean, it's really a complex adaptive system. It's hard to pin down, especially this soon after an incident like this, to get a hard number on things. But you can rule of thumb, ballpark things is that, well, it costs almost twice as much to truck something across the country from the West Coast to the East Coast as it does to ship it from China to the West Coast. So it can be a big increase in cost. It'll depend on how much volume we see shifted to the West Coast, how much impact that is. But a high price of shipping flows directly into the cost of goods that people pay every day. We saw during the pandemic when prices surged, the price of ocean freight went up about 10 times in the spot market if you didn't have a long-term contract. that was leading in our economists' estimate to about 3% impact on goods inflation, 3% increase in the prices that we all pay for goods that are imported, which is a huge percentage of the goods that we consume. So I wouldn't expect anywhere near that level of inflation impact, but it could be if you certainly 0.5% or something like that if this lasts, and if the industry isn't able to handle the surging volumes and we start to get congestion and delays.
Ryan Peterson, we really appreciate you taking the time to join us here in Yahoo Finance this morning, founder and CEO of Flexport. Thanks so much. Chinese President Xi Jinping meeting with U.S. business leaders in Beijing earlier today, including Blackstone CEO Steven Schwarzman, FedEx CEO Raj Subramanian, Pfizer CEO Albert Bourla, and Qualcomm CEO Cristiano Amon. Now, China's motives are clear: to boost growth of the world's second largest economy after foreign investment shrank about 8% last year. But the country is critical to U.S. businesses, too. Pfizer, for example, has been rooted in China for over 30 years, investing more than $1.5 billion over that time in the country. Well, joining us now is our very own Rick Newman. Rick, lots to discuss here, but first, just big picture. Is this a sign, do you think, that the relations between U.S. and China are maybe improving a bit?
I'm not sure about that. I think this is an effort to do exactly that, to improve them. And I think about this on two tracks. So one is the Chinese economy, which has slowed by a lot. I mean, they did not come roaring out of the COVID pandemic anyway like the United States economy did. They've got a lot of structural problems. So they've got this huge overhang of real estate debt. I mean, basically, they have a situation that was similar to our housing bubble bursting, if not worse, because it's just pervasive across the country. And it's not clear whether that is resolved or not, maybe not. So that's the economic track. There's also this, what you might call national security or geopolitical track. So just keep in mind, President Xi Jinping has said he wants his military to be able to invade and take control of Taiwan within 5 years. So if you're a CEO who's overseeing a business, doing business in China or investment in China, and you hear the leader of the country saying, we're basically preparing for war. I mean, the question for Xi Jinping is, why should I invest in your country if you're going to bring the whole thing crashing down by starting a war in 5 years? What's your problem, man? So that might be a blunt way of addressing the question. Who knows if these business leaders are going to get any straight answers or transparent answers? It could just be a lot of the usual formalities, technicalities. We welcome you with open arms, but no specifics. So we'll find out.
Does this change materially where businesses want to do even more kind of relationship building within China in the near term, knowing how much of their revenues for some of the most internationally exposed are tied to that region?
Right. I mean, so the trend is U.S. businesses are getting increasingly less revenue and less profit from China. And that makes sense. I mean, a lot of these companies, I used to follow the auto companies in China, General Motors, Ford, and Jeep Chrysler. And they were banking money, minting money in China, after China entered the WTO in the early 2000s. They didn't have domestic industries. They needed foreign expertise. They needed foreign products. That's what they bought. And obviously, over the last 20, 23, 24 years, China's domestic industry has gotten quite competitive. If you just look at autos, their autos are pretty close to competitive with Western products these days. There's even talk that they're trying to get Chinese-made autos into the European market, into the U.S. market, and that's a big problem because they're pretty good and they're also really cheap. It's just not easy pickings in China for U.S. companies the way it was 10 or 15 years ago. All these companies that have been there, they're still there. It's still an important part of their global business. But China wants more investment. Let's be honest, they also want more Western technology. It's well known that they steal Western technology every chance they can get. That's why they have the joint venture model. You got to partner with a Chinese company. They have access to your technology. That's one of the things Chinese wants. And, the U.S. has just been tightening up on all that.
All right. Rick, thanks so much for covering this, breaking this all down for us. Appreciate it.
Sure thing.
Keep it locked here on Yahoo Finance. We have a lot more coming your way, from huge guests to team coverage out in the field. First, we have Vlad Tenev, who is the Robinhood CEO. He's on deck Plus, shares of the investment platform rallying this morning on news of its new credit card. We dive into that at 9:40 a.m. Eastern. And our very own Pras Subramaniam is joining us live. There you see him smiling and everything at the New York Auto Show at Javits in New York City here. He's going to bring us the latest on EV competition and new car announcements throughout the shows. Yeah, your ears are burning because we're talking about you, Pras. Plus, we have the Corcoran Group founder and real estate mogul, Barbara Corcoran, joining us live in studio, 10:30 a.m. Eastern time, folks. We dive into the impact of the realtor antitrust settlement on the housing market and the latest housing data. All that and much more coming to you here on Yahoo Finance.
Time for today's stock to watch, and that's GameStop. Shares plunging this morning after missing revenue estimates in the fourth quarter. It also slashed jobs as it attempts to cut costs. Now, GameStop's plunge putting a dent in the broader meme trade. Reddit is pulling back slightly today. You have DJT, though, that's still rallying to the upside in pre-market trading, up another 20%. But, Brad, we're talking about this because up until today, and even in today's action, we have seen the return of the meme stock mania. Yes, GameStop might be falling out of favor. Reddit taking a bit of a break from the massive run-up that we've seen since it went public just last week. But Trump media once again moving to the upside. And what this really signals, though, for the market, the appetite, the risk-on appetite, clearly still there. Whether or not it's comparable to what we saw back in 2020, 2021, when we think about GameStop once again, but also AMC, that is still up for debate. But clearly, this could point to some of that froth that's in the market.
Yeah, you mentioned the GameStop news off the top, and on this earnings, one of the huge things for the company that still doesn't have an earnings call, by the way, so you don't get to hear from the executives. They just give us an update on this business strategy, seemingly once every 18 months at this juncture. But what they're talking about this time around is establishing omnichannel retail excellence. That's kind of similar to what they were talking about before, achieving profitability and then leveraging brand equity to support growth. Okay, so ultimately, the achievement of profitability here, and this is where it comes back to what you were mentioning on the cost restructuring, this cutting of jobs, realigning that with current and anticipated future needs. And you really just had to go into the 10K to ultimately find out what they were actually talking about within this. They've taken cost reduction measures, other initiatives, they say, to really improve the efficiency of their operation, including the reduction of headcount here. And so that is going to be a major kind of lever that it seems like they're going to be willing to pull. We'll see if they have to close certain stores, unprofitable stores. You got to wonder, and especially as they laid this out in their own risk factors, which has been a risk factor ever since much of the gaming industry went more to the cloud, which was the fact that people don't need to step in the store to buy many of these games. And so at the end of the day, the way that you're going to trim a lot of overhead is to start shuttering some stores probably, or looking at the hours that they're operating. And then even more so, just the amount of headcounts that's necessary to operate this entire behemoth of a gaming company that unfortunately most of it can actually just go through some of the consoles that are out there already.
And it's also funny that we're also talking about GameStop earnings on a week when Reddit just went public, and Reddit was really a forum where many of these GameStop trading retail traders have been talking about those trades, where exactly they see the stocks going. Now Reddit also being grouped in the meme trade as well. So there is some excitement around those names. GameStop, though, clearly under pressure today because of those disappointing results, and lots of questions about the fundamentals of that business.
But for the short interest that's out there, which was the entire thesis, right, behind where much of the conversation was, just look at some of the highly shorted positions that were out there. And in GameStop's case, I mean, the short, I don't know if we've ever seen a company as shorted as that, but all things considered here, I think a lot of these smart institutional short money is probably not touching any of these names right now because they know then they've got to come in at some point and cover, and you're just exposing yourself.
Learn the lesson 2020, 2021. All right, well, the New York Auto Show kicking off today, and Yahoo Finance is bringing you all the big announcements live from the event. Our very own Pras Supermanian is on site. And Pras, it's a pretty cool event. I was there last year. What are you seeing so far?
You know, Shauna, last year when you were here, it would have been all EVs everywhere. It would have been all about EVs, EV trucks, EV cars, EV SUVs. This year, it's seeing kind of a pivot here, right? We're seeing a different kind, back to normalcy, really. More cars with traditional powertrains, and that brings me to hybrids, right? These kind of the renaissance of hybrids. You're seeing Toyota with the new Camry, that's fully hybrid. They have a new Tacoma, which has a hybrid powertrain. Other cars from Hyundai and Kia also kind of focusing on that alternative powertrain that they think that people want to buy as opposed to EVs. And finally, Shauna, we're big on people's minds here is the situation in Baltimore, the port situation, what's happening there. A lot of automakers use that port to bring in cars, bring in parts that they need to service these cars. So we're going to be asking these CEOs about that, what's going on there, and are they able to sort of work around those issues there happening this week in that really kind of tragic situation.
Pras, just lastly, while we have you as well here, I mean, this is going to be an annual tradition that you're going to have to now continue for us here at Yahoo Finance. You need to find a frunk out there. Find a frunk and see if you fit in it, because that's just, I don't know, that's just our new tradition that we got to try out. Who has the best frunk?
That's your assignment.
That's the assignment.
We're going to be speaking with you in 20 minutes, so you got to get running around the floor room because it certainly is a massive, massive showcase down there. All right, Pras, thanks so much. He has much more coming up from the New York Auto Show. Pras will be speaking with executives from Polestar, Nissan, Kia, and Toyota throughout the day today. And that's not all. Coming up tomorrow, Yahoo Finance Executive Editor Brian Sazzi speaking with GM CEO Mary Barra. That's part of Yahoo Finance's Lead This Way series. That's live tomorrow, Thursday, March 28th at 10 a.m. Eastern Time. Coming up next, we are just minutes away from the opening bell on Wall Street. We're looking at futures pointing to gains here at the open. We've got the biggest market movers for you when we come back.
Bing bong, that's the opening bell on Wall Street and in Midtown Manhattan. At the Nasdaq, you've got Blackhawk ringing the opening bell, not to be confused with the Blackhawks of Chicago. However, the Funfetti is the same color. And in Midtown, well, actually, that was Midtown. In Wall Street, Barclays and the New York Liberty. I don't see Stewie up there. Oh, my goodness. But I do see the mascot.
I do see the mascot there.
Yes.
That's a cute mascot.
Great mascot. Oh my goodness, love animal mascots. Anyway, let's take a look at the major averages here. The S&P 500 notching 3 consecutive days of losses. Let's take a look at some sector activity out of the gate as of right now. We've got more green on the screen than red. And in fact, energy, really only thing in negative territory at this juncture. Real estate, though, leading the pack. That's up by about 1% here right now.
Yeah, certainly we're seeing some resilience here, and some utilities amongst the leaders here for the month of March. Consumer discretionary holding on to those gains up just about 0.6%. Also financials, which has really been an outperformer, Brad, since the start of the year, moving to the upside once again today. It looks like an early action up just about 0.5%.
That's right. Let's throw it on over to Jared Blikre from More. He's at the big board with the Wi-Fi Interactive loaded up behind him. Jared, take it away.
Loaded up. I'm really glad you said financials, Sean. I'm not going to focus too much on this, but they have been hitting record highs recently. And this is just another sector that has exhibited a lot of strength. Let me just show you what's happened since I was writing this about the morning brief. If you take a look at the best sectors going back over the last 5 months, and the S&P 500 has now been up 5 months. Financials right there at the top. There we go. Financials, communication services, and tech. Those are the 3 biggest ones. Those are the mega cap sectors. And then you have industrials also up 30%. So this is a really broad-based rally. It's nice to see that finally opening up here. Let me put this on an intraday basis and get back to some of our tickers here. Here's the Nasdaq 100, and you can see a few red spots interspersed here. Pinduoduo down about 2.3%. For the most part, a lot of green, not a lot of dark green, but I do want to focus on some of the trending tickers that we have at Yahoo Finance. Top of that list, Trump Media and Technology Group. Let me just show you our quote board here. That is at $69.67. This has been a volatile stock. Let me show you what this has done. This includes all the DWAC history. So yesterday, the ticker changed to DJT, but it has the old ticker's history. This stock has been about $100 at the beginning, after it went live in 2021, 2022, now in the middle of its trading range. Also want to show you real quickly, Robinhood. Now, this is a max chart, so it's still in the bottom end of its range, but check out the year to date. It has really come alive with the crypto industry, and here we see Robinhood up 57% today, or as of today, this year.
Yeah, moving up a little bit more here shortly after the open. All right, Jared, thanks so much. Well, stocks opening higher here this morning. The S&P 500 looking to snap that 3-day losing streak. Investors also looking ahead to that key inflation print, PCE, that we will get out on Friday, even though I was going to say before the bell on Friday, but markets are closed on Friday. So here with more is Brian Jacobson. He's Annex Wealth Management's chief economist and a strategist. It's great to see you here. So talk to us just about some of the action that we've been seeing in the market this week. And I want to start with the meme mania, the frenzy that we are seeing around just a handful of names. Does that signal anything worrisome to you just in terms of some of that froth that we could be seeing in the market?
Yeah, thank you for having me. And yeah, that's something that we've really been watching. It is somewhat reminiscent at a much smaller scale about the meme mania during COVID and that. But, this is much more concentrated. It seems like not quite as broad based. I think it is indicative of investors really trying to, that fear of missing out, that FOMO mentality. They are trying to find the next hot thing and they're just beginning to chase it and pile into it. That obviously can work well, but it can also then end in tears, especially if you don't get into those names early enough. But when bubbles begin to inflate, when they begin, it's not a bad time to start investing. It's when you get towards the end when they're beginning to burst, and it really takes a lot of prudence and focusing on the trading conditions to identify when those bubbles might begin to burst.
And so, Brian, here, that aside, as we kind of think about the broader market activity that we've continued to track here, we've got, of course, new all-time highs that we've seen over the course of this year already, and kind of this drift higher as we're still having lingering questions about whether or not there will be an AI bubble that bursts. In that kind of drift higher mentality, perhaps, for some traders and what we're tracking, where are the sectors that could still potentially outperform from your perspective?
Yeah, in our investment committee, we've been talking about that as far as what's next, as far as where the market narrative might shift towards. All right, so the people who like to chase the memes, what is the next meme? It could really be in the small cap space, and then also industrials, materials, and even the always boring utilities sector. Those are the areas that have underperformed, and we think that they could outperform for a couple different reasons. Utilities, perhaps, if we get a little bit of stability with rates, and if they begin to drift lower, that could benefit utilities. But then as far as industrials and materials, those are much more cyclically oriented. And if we get manufacturing beginning to emerge from this long hibernation that it's been in, we think that's an area that is really poised to outperform for the next, not just 6 months, but perhaps even a longer period of time if you look out maybe 3 years.
Brian, where does that leave tech?
Tech is one of those where we think that you have to be in it to win it. So as far as we are allocated to tech, and actually currently we have an overweight to a lot of the technology names. It's just that once we get to a point where we get through earnings season, we think after we get out of earnings season, that's an opportunity to reassess where the valuations are to perhaps start underweighting. The bar is a little bit, it's been raised, but they have a history of beating expectations. We think that this could be a period of time in which prices have really anticipated the earnings, and now they actually have to grow into some of those valuations. So it could be almost sort of a movement laterally or to the side for tech over the next, for the balance of the year.
It's really interesting too, because as I think back to some of the data that FactSet publishes as well, talking about they're projecting a 7% increase in S&P 500 price over the next 12 months by some industry analysts here. It's going to have to come in that time on increased earnings expectations. This guidance coming in perhaps stronger than expected, even with the face of the likelihood of a recession and those concerns still lingering here. What is it that companies can say that will negate some of those concerns that still linger?
Right now, I think the biggest concern is around margins. What's really going to happen with that distance between top line revenues and the bottom line earnings? What we saw with the latest earnings season is earnings growth was really good while the sales growth was fairly weak. And so that actually shows that the profit margins, that distance between them, is pretty resilient. Companies have been able to right size and really navigate sometimes very challenging environments. Are they going to continue to be able to do that? We think that a lot of the smaller companies and mid-cap companies have really good operating margins here and operating leverage, such that if you do get just a slight uptick in growth in their particular sectors, that could really compound to the bottom line for investors.
Brian Jacobson, Annex Wealth Management Chief Economist and Strategist. Brian, always a pleasure to get some of your insights. Thanks so much.
Thank you.
Well, coming up, Robinhood launching its first ever credit card. Our executive editor, Brian Sazi, sitting down with CEO Vlad Tenev. There you see them. On the other side of the break, we have that conversation.
Consumer spending is holding strong, and Robinhood is looking to cash in. The company announcing the launch of its first ever credit card, the Robinhood Gold Card. Vlad Tenev, Robinhood co-founder and CEO, joins me now. Vlad, always great to get some time with you. This is a pretty big deal for your company. We've been tracking your company in the weeks ahead of this launch. Why are you getting into the credit card business?
Well, simply put, our goal is to be the place where our customers custody all of their assets and where all of their transactions go through. And if you look at how to grow wallet share and help our customers build wealth, their spending is one of the most important ways they use money. And the bulk of our customers are credit card primary. Once you start using a credit card, you tend to not go back to other methods. And so we knew that that was a place where we wanted to be. And we felt like if you look at the credit card business, very high margins, very profitable. There's really an opportunity to cut out the fat and give more value into the pockets of our customers.
What is it like now that you're going to go head to head with some really old companies? I mean, you have Amex, Visa, and a MasterCard. Do you worry about that you can't take market share from these companies?
I mean, when we look at what we wanted to do, we didn't want to just come out with a Me Too product. We wanted to differentiate on rewards. We wanted to differentiate on user experience, and of course, the design. And I think we've been able to do that in all three categories. The rewards, I believe, are the best in the industry. Nothing can compare. The design and the user experience, the digital experience, I think we're very proud. The team is very proud of what we've built. We really have, not just business people and technologists at Robinhood, but we have great artists too. And I think we've made what I believe is the most iconic card on the market. And it resonated with customers. So during the event, which was at nighttime.
It was very Steve Jobs-ish. I was watching it. You were on stage unveiling the product. It was something different for Robinhood, I think.
Something different. And within the first few hours after the event, hundreds of thousands of people have signed up already to get the card. So the response has just been amazing.
When does it officially launch?
We're going to start rolling it out in a number of weeks to the outside world. I mean, some people already have it, but yeah, I think
that's a lot of folks. So what is
it's very soon.
What's the criteria to get one of these cards, and do you bring that risk onto your balance sheet? What are the financial mechanics behind it?
Yeah, so the criteria is you just have to be a gold member. One of the things that's really special about this card is it's a premium card. So it's a card that, to even get rewards and perks approaching this, you have to be a high net worth individual at other places. And most don't even offer anything like it. And we wanted to make it available to all gold customers. And gold is as little as $5 a month, right? So it's really intended to be a mass market product.
Why no fee? I talk to the Amex team all the time. They're making bank. I mean, they charge these fees every year. People are willing to pay fees. Do you see yourself putting a fee on this at some point?
Well, so you have to be a gold member.
So it's what, $5 a month?
Yes, and there's an annual plan as well. But I think adding additional fees is something I've generally been against because it makes it complex. So we wanted to make it as simple as possible. If you're a gold subscriber, you get that private client experience that you'd have to be a high net worth customer of a big institution to get. And we wanted it to be accessible to everyone.
Is this, how important was it to launch before the second half of this year? It looks like we might get some rate cuts. Theoretically, that should be good for consumers. And here's Robinhood with its first ever credit card. In year one, how big could this be financially for your company?
I think that we're a very long-term focused company. I think the goal is obviously, the intention is for the business, the credit card business on a standalone business to be a profitable business for Robinhood. We think we'll get there. But the other thing we really care about is growing the ecosystem. When we look at customers that sign up for Gold, we see that they adopt our other products at a much higher rate. The average revenue that we generate as a business from these customers scales with the amount of value we're giving them. And once they're using the 5% APY on your cash, which is one of the highest interest rates out there, the retirement match, I mean, you're getting a ton of value. And we see customers putting more and more of their wallet share, more of their money into Robinhood, and that growing over time. So I think it could be very significant. As we add more things to gold, the value proposition becomes so strong, and I think we will see people putting more and more of their finances onto the platform.
I was reading a good note from the Bernstein team this morning on the product launch, and I came away thinking, Robinhood's not really just a trading platform anymore. How do you want investors to view your company?
Well, I think over the long run, I've been very clear that the goal is for all of your assets to be custodied in Robinhood, all financial assets, investment, retirement. And every time you do a financial transaction, that should go through Robinhood. We should be able to help our customers with that. And that space, the overall space, is gigantic. I mean, even just one of these new product lines that we've launched, retirement, which we launched a little bit over a year ago. So in the first year, we got up to about 1.4 billion in assets under custody in retirement accounts. And then we just announced that yesterday we crossed 4 billion. So it took us about a year to get to 1.5 billion. And then the first 3 months of this year went from 1.5 to 4 billion. So the growth has been really amazing, kind of on the backs of the 3% match that we're giving customers. But you put that in context of the overall IRA industry. So self-directed retirement accounts in the US have 14 trillion in assets, right? So it's a gigantic market. And we just, I get excited by the fact that we have what I believe is the best product by far. And there's so much room to run with this, so much more assets we can serve for our customers.
Just given the focus on retirement, and I'm hearing a more mature Robinhood from you, Vlad, and I've had to continue to hear this. Do you agree, with Larry Fink, that we are in a retirement crisis, and how do your companies like yourself evolve to address something like that?
Yeah, I mean, I agree. I think people really need to take the initiative to take care of their retirement on their own. We're kind of past the point where you join a company, you work there for 20 or 30 years or more, and you can count on the pension plan. People are working multiple jobs in some cases. They have multiple sources of income. They go from one job to the next. And so when you're in that regime, it's even more important to have an individual retirement account and take control of your own finances. And we just didn't feel like there were great products that made that really easy for customers. I think for a really long time, the retirement account was viewed as like this profit center, as a way to kind of squeeze more economics from customers into the bottom lines of these big, bulge bracket brokerages. And so the way we kind of combat this and help solve the problem is by building these great products. And can your individual retirement account actually compete with an employer-sponsored plan? And I think with things like the match, getting the user experience really good, we're also now offering retirement benefits to gig economy workers and kind of stepping in to provide that safety net. And I think you will see that continuing to resonate. More and more customers, more and more independent contractors kind of opting for our individual retirement account products.
Well, fascinating to follow this evolution of your company. Vlad Tenev, co-founder and CEO of Robinhood. Thanks for always making time for Yahoo Finance. We appreciate it.
Thank you. Always happy to be here.
All right, coming up, we're heading back to the New York Auto Show. Our very own Praz Subramanian. You see him there. We'll bring us a conversation with the CEO of Polestar. That's next. Don't go anywhere.
Welcome back to the New York Auto Show. We are here live with Polestar, the EV company, here with two new cars. Thomas Ingenlath joins us now to discuss. So, two very big North American debut, the Polestar 4, and of course the Polestar 3 going on sale soon. Talk to me about this car, Thomas. Why is it so important to the brand?
Yeah, indeed, Polestar 3 is so important because A, it's an SUV. We were, of course, waiting for having a SUV, a true SUV in our portfolio. It's as well very much the heart of the company, the premium performance. We had now journalists driving the car and they just simply write how much that is a surprise, how a big SUV as it is can drive so sporty. That's exactly what our brand is about, bringing that joy and fun of driving of an electric car to that premium segment.
Right, and this electric design almost too. You know, also with the Polestar 4, with that kind of swept back design, everyone's heard about the no rear window, things like that, but it's very cool. What are customers telling you about the Polestar 3 and the Polestar 4? Is there a sort of high demand there for these vehicles?
Well, to start with, everybody is, of course, complimenting us for the design, which I like a lot because, yes, it's core part of our company to have that great, cool Scandinavian look. Of course, electric cars can be giving you so much space inside. Both cars have an incredible second row comfort. They have really cool tech in there. I mean, Google Android system in our car, the gas system is in both cars, a great benefit for the customers. And of course, range. I mean, we had done great steps in the past. Now, these cars with both of them are over 100 kilowatt hours batteries, of course, give you big comfort in terms of range.
So before we talk about kind of the bigger picture of the EV space, I want to talk to you about Baltimore and the situation there with the port. I know a lot of automakers use that port as a way of entry for a lot of their vehicles and parts. Is that affecting Polestar currently at the moment?
Currently not. I've checked it this morning. We are actually right now, as far as I see, not affected in the deliveries which are happening in the coming months. So thank God so far not.
So, you know, kind of recapping here, Polestar 3 coming to customers in Q2. We're going to see Polestar 4 later today, and also customers can sort of, I guess, place orders for that eventually, sooner rather than later. So 2 SUVs in the market, plus the Polestar 2 existing in currently here. Big picture-wise, do you think that the way things are kind of going with EVs in America, there's a bit of enthusiasm kind of waning a bit from a demand point of view. Do you think it's kind of more preferable to be in the upper end, the luxury end of the space where demand is a bit more inelastic? That's where Polestar's position. Is that where you guys want to be?
That's exactly where we are aiming with these cars and where we believe as well. You know, what's crucial is what type of desirability brings your car to the table, how technology-wise advanced. That's what our customers are searching for. And for us, actually, it doesn't make a difference who are we competing with. Is it a combustion engine car? Is it an electric car? We are in that performance premium segment out to convince with the greatness of our products.
So real quick, you know, we have obviously Polestar's in the global markets, China, Europe, and also America. But in the US, how is that market shaping up for you guys for Polestar right now?
Well, we have definitely that journey where US, especially with the production of Polestar 3 in South Carolina, will become more and more important in our business. The aim is to reach a percentage of all of our 30% of sales for Polestar happening in the US. At the moment, the majority, of course, is Europe. That's where we were born, where we are strong, but it will shift, especially with Polestar 3, of course, a larger extent to the US.
So in the States, at least, we're seeing more Polestar 3s here potentially in Q2, and also production of the Polestar 3 happening, I think, later next year, if I'm not mistaken.
No. Already in 2024, by summer, we will shift production to South Carolina. We're very excited about that.
Oh, well, that's good to hear. I guess I was mistaken. I'm glad, Thomas, thanks so much for joining us. I appreciate that clarification about where the car will be built. Back over to you guys.
Welcome back to Yahoo Finance. I'm Shawna Smith alongside Madison Mills. We are 30 minutes into the trading day. So let's take a look at how things are shaping up so far. We're still looking at green across the screen. We got the three major averages there up for you. You've got the Dow up just about 300 points. The S&P looking to snap its 3-day losing streak today, trading to the upside up just about 0.4%. And the Nasdaq also in the green today, up just about 24.
And taking a look at the sector activity, interesting, tech is starting to dip into the red. When we started out our day here, it looked like tech was going to be decidedly in the green. They're just about flat right now. Yesterday, a lot of the declines being led by NVIDIA, about a quarter of the declines for the S&P. Having said that, utilities, the second to top performing sector on the day so far. So that is going to be interesting to continue to see if that can support sort of a broadening narrative coming here. One of those reasons being that Raymond James sold off a lot of shares in Dominion Energy yesterday. We're seeing a big recovery there today. And the healthcare sector also performing well, up about a 1% move there, partially because of some idiosyncratic company news. Moderna announcing 3 additional vaccines. Our very own Anjali Khemlani speaking with the CEO here at Yahoo Finance. That interview is going to be in our show a little bit later today.
All right, well, Maddie, as we see the broader averages move higher, we want to put the spotlight on 2 stocks that we were watching here this morning, and that's Disney and Netflix. Both of those names hitting fresh 52-week highs this week. Now, we have seen 2, though, very different narratives play out at these 2 companies so far this year. So we want to bring in Yahoo Finance's Alexandra Canal here to explain some of that action. And Ali, let's start with what you're seeing from Disney.
Yeah, so Disney, a very interesting story, considering last year we were at multi-year record lows, but we're hitting that 52-week high. Shares trading just above $120 a share. Year to date, they're up 34%. If we take a look at a year chart, they're up 27%, I would say. And you're seeing those multi-year record lows happening around the fall of last year. And there's a few reasons why analysts and investors are pretty bullish on the stock at large. So let's tick through some of those reasons. Number one being the fact that the turnaround plan that we're seeing from Bob Iger, it's beginning to take shape. We've seen the purchase of Hulu, which a lot of analysts on Wall Street think is going to be really lucrative when we think about subscriber acquisition. Hulu has a lot of really great programming that if you pair that with Disney Plus, it's a really attractive offering for consumers. We've also seen Bob Iger really double down on the fact that they want to produce quality content over quantity. They've already scrapped some projects there. And they also are committing to different initiatives like the password sharing crackdown. Bloomberg Intelligence was out with a report that the password sharing crackdown could add $2 billion in revenue for the company. So that's certainly a positive moving forward. And that's all contributing to really strong guidance when we think about earnings and free cash flow. That is important because it really is about profitability at the end of the day. Barclays recently upgrading Disney, and they said that they expect Disney Plus and the company's streaming services to be profitable before the target date. Disney says that by the end of 2024, Disney Plus will be profitable. Barclays thinks that could be sooner. And then finally, we have a lot of really great partnerships coming up with Disney, especially as it relates to sports, as it relates to gaming. We know Disney has been doubling down on its sports initiatives. It's going to launch its ESPN fully over-the-top service next fall, so 2025. They are still searching for a partner there, but that could be an interesting move depending on who they go with. Perhaps if they partner with an Amazon, that could be something to watch. And then they also have that partnership with Warner Brothers Discovery and Fox coming out later this fall. That's the skinny sports bundle there. And so we're seeing when it comes to what Wall Street is saying, 28 buys, 7 holds, 2 sells. Of course, we're 1 week out from that heated proxy battle with Nelson Peltz's shareholder meeting in a week from today that's going to really determine where that stands. So we could see some volatility leading up to that, but it seems like Disney is in a pretty strong position at the moment going into that meeting.
And Ali, another stock I know you're watching this morning is Netflix. We have news about a price target change, Wedbush removing the stock from their best ideas list. What's going on with Netflix today?
Yeah, so Netflix also hitting 52-week highs. If we take a look at the year-to-date performance, we're seeing the stock up also about 27%. I want to take a look at a 2-year chart because post-COVID, Netflix really struggled. They added a bunch of subscribers during that stay-at-home trade, but as the COVID trade sort of waned, we saw that that really hit the stock price, but they have certainly climbed back. And I do think that the concern here from Wedbush is that a lot of these initiatives are already priced into the stocks, but there's still a lot more room to run here. So let's tick through some potential upside reasons why Netflix is doing so well. One is healthy subscriber growth. We've seen them continuously add subscribers over the past few quarters. Now, a lot of this has to do with the password sharing crackdown, which I'll get into in a minute, but also the fact that they've just been producing really solid content, not just at home, but also overseas. They've been really committing to international investments, doubling down on their localization strategy, and that's helping them with emerging markets. I mentioned the password sharing crackdown. That, I think, is the issue where some analysts are saying that's largely priced in at this point, but we have another revenue driver, and that is the advertising tier. And by 2025, 2026, we're going to see Netflix see some really significant growth in the ad tier that's going to add to revenue. And then when you think about their partnerships, they have the WWE Live partnership. They're really expanding into live programming. They are doing more investments when we think about gaming. So the future is bright for a company like Netflix. They are targeting margins above 20%. They certainly have a lot of optimism on the street with 40 buys, 16 holds, and just 3 sells. So another company that we're watching very closely, and we'll have to see where things go. They report earnings in mid-April, so we'll get yet another update very soon.
And another season of busy earnings for you to cover, Ali. Thank you so much. Really appreciate your reporting as always. Well, it's a big week for meme stocks, with GameStop shares plummeting after its fourth quarter sales dropped compared with a year ago. The company almost killing the meme momentum, which was reignited by the public debut of the platform that started it all, Reddit. Shares of that social media platform bouncing back after initially dipping after GameStop's results came out. We're also watching another meme stock contender, shares of Donald Trump's Truth Social media company, DJT, surging after its public debut on Tuesday. With new names in the mix, what's next for the meme trade? Joining us now, we've got Steve Sosnick, Interactive Brokers Chief Strategist. We also have Steven Sykes, the COO of investing platform Public. Guys, thank you both for being here. I love that we've got the Steves joining us this morning. Steven, I'm going to start it off with you. I'm curious, you're a great voice to speak with on this because you're the COO of an investing platform. Talk to me about the biggest takeaway that you've had so far regarding meme stocks in terms of the user behavior on the Public platform.
Yeah, I mean, I think it's interesting that this, this idea of meme stocks has become a real trend, but I think it really reflects sort of two things that we know to be true about retail investors and what we see as being highly predictable behavior. One, retail investors really love to follow trades that they are familiar with, right? Companies they know, companies they understand, and familiarity can come from, again, them being customers that use the products, or even like learning about it on social media or Reddit, like we've seen with this sort of meme stock trade. So I think that level of familiarity really drives retail investor interest. And then the second thing we know is going to drive retail investor interest in trading behavior is volatility and momentum, right? And so I think as we see things like Reddit debuting and having a very strong debut against a pretty short, pretty small float, I think we see that drawing real attention from retail investors. I think we've seen the same thing with the DWAC to DJT de-SPAC. We've seen really strong price momentum over the last couple of days and really strong volatility. And I think that's brought a lot of retail investor interest.
And Steve Sosnick, given what Steven Sykes was just saying, just about the appetite that we're seeing, this risk on appetite, does that point to froth then in the markets at these current valuations?
Good morning, Shauna. I think if we're not there already, we're getting there. I think, the beginning of this rally, it's been momentum all along since November, but the leading momentum stocks have generally been stocks that have been delivering the goods. NVIDIA is sort of the poster child for the momentum trade, but to be fair, I mean, that company has been, beating on revenues and earnings, and then guiding higher, and then beating the higher estimates. So it does deserve that momentum. But when you start to get into things, when you start to see GameStop go up, when you start to see Reddit go up, largely just because other things are going up, and certainly, DJT, which from a fundamental basis does not really have much to speak of in terms of sales or earnings to justify roughly $9 billion valuation, this does become a very frothy market, and we're starting to see people chase stocks just simply because they're going up, not because of any fundamental reason. That to me indicates froth.
Well, Steve, I want to stick with you for a second then, because I'm curious if we're not seeing as much frothiness. Just take a step back for me and tell me what you think a meme stock is, because if we're talking about the fundamentals in this conversation, I feel like we're already not talking about meme stocks anymore.
Yeah, well, thanks, Madison. I mean, what I've basically been, I've been trying to wrestle with this definition for some time, and those were the three things that I put in my rubric yesterday. I came up with one, and number one is sort of a quasi-religious fervor. It's one thing to be enthusiastic about a stock; it's another thing to just be so hyped up about it. Think about how the real apes were in AMC, the real devotees in GameStop early on. Certainly, one can say that about the former president's base, who I think was helped getting DJT stock moving. Second, and sort of part and parcel of this, is disregard for fundamentals. If you're believing in the faith of a stock, if you have sort of a non analytical view of the stock, well, then you could disregard the fundamentals. GameStop, I guess, is resounding on fundamentals today, but the rally that we saw earlier this week had nothing to do with it, and many of the rallies we've seen overall had nothing to do with it. And it's a very expensive stock by any conventional metrics. And another, element tends to be high short interest or a difficulty in borrowing it. As Stephen mentioned, in the case of DJT shares, it has a very small float, which means that those who believe it's overvalued find it almost punitive to bet against the stock right now, because it's if you want to borrow it, it's cost you about 150% annualized to do so. That's huge. And that's makes it very risky, very expensive. And those shorts, when they get squeezed, add to the fervor and help turbocharge the stock when it gets moving upwards.
Stephen, is this similar in your view and the activity that you're seeing on your platform? Is it similar to what we saw back in 2020, 2021, or are there key differences to the activity that's happening today versus what we saw back when GameStop and AMC really first started to coming to the spotlight once again?
I think they're echoes, right? It's rhyming, but I think it's a very different sort of market. I think we've had a retail investor over the last 2 years that's been humbled and had to reevaluate their strategy. I think as a platform, we've seen significant increase in allocations towards fixed income and treasuries, and I think we're just now in sort of the foothills of retail investors returning towards the more speculative trades. And I certainly agree with Steve that we do see some level of disregard for the fundamentals among retail investors in these trades. But I don't know that I would totally call it irrational, right? I think we've seen a lot of evidence through these periods of time where, hey, sometimes things that look irrational can stay quite irrational for a long time, and retail investors that feel like they have a good sense of that momentum can do well. So I wouldn't totally characterize it as always an irrational trade, but it's certainly that. It's a trade. It's not a long-term investment. And I think, again, as we all run sort of large, broad platforms with millions of customers, we have some investors that are long-term buy and hold investors. We have some that are traders and trying to take advantage of volatility and momentum in the market. And I think they see an opportunity here more so than sort of the quasi-religious fervor that you might have seen in prior eras.
Well, Steve, I want to end with you then, because I wonder, as we're kind of nearing the end of the quarter, what risks could be involved for these meme stocky names, and whether quarterly institutional rebalancing could be, weighing down some of these stocks, or if there are other risks that folks should be aware of.
Well, Maddie, I think these sort of exist, in a different sphere. If you want to ask about, the high momentum names, let's say, let's say an NVIDIA, let's say even an SMCI, something of that nature, those are subject to institutional rebalancing. I think in the case of, these very much individual investor-driven names, and by the way, it's not just individual investors. There are very aggressive small and large trading accounts that jump in when they see this kind of volume and volatility. But that's far less subject to quarter-end type of considerations. I don't think someone who is, who's willing to chase some of these stocks higher is being very concerned about the idea that the quarter ends after the close tomorrow. So it's a different set of considerations. But the volumes are to Stephen's point. I mean, Reddit was the fourth most active stock on our platform over the last few days, and DJT is somewhere in the teens. So, there are different motivations, but it's not purely retail, but I think the investors who are driving the bus on a lot of these stocks are not really thinking about the quarter end in the same way that, let's say a pension fund would be.
All right, Steve Sosnick, Interactive Brokers Chief Strategist, and Stephen Sykes, Public's Chief Operating Officer. Thank you both so much for taking the time to join us here this morning. Great to get your insights. Let's get to a trending ticker here on Yahoo Finance. Shares of Carnival, well, they are taking a hit this morning. We're looking at losses of just about 3%. Now, the company reported a narrower than expected loss in its first quarter, but it also warned, though, that its guidance does not reflect the current estimated impact of the collapse of the Francis Scott Key Bridge in Baltimore. Now, Carnival is estimating that it could actually result in a hit of up to $10 million to its net income. That's a big reason why we're seeing shares under pressure here this morning. And Maddie, it's really overshadowing some of the trends that you were pointing out before we went to air that we are seeing in Carnival's business, what we're seeing in many of their competitors' business. When it comes to record bookings, the interest that people are showing, they're willing to pay for their cruises. But again, this hit potentially here that is not included in their guidance, all related to the unfortunate tragic collapse of the bridge yesterday in Baltimore, could have a real impact on their business.
Yeah, I'm interested in hearing from analysts about this today because I don't quite understand the degree of the market reaction given some of the good numbers that were in the earnings print. $10 million is chump change for a company of this size. So I have to wonder whether people are thinking that that could be an indication of broader losses to come. And just to run through a couple of those good numbers here, booking volumes hitting an all-time high for 2025 even. Adjusted EBITDA for the quarter, approximately $1.05 billion. That's over 50% growth compared to the second quarter of 2023. They also have been criticized for having a lot of debt on their balance sheet. They were able to redeem and retire about $1 billion worth of debt in the first quarter of the year. So that is a lot of good news for them. And we're still seeing the stock down a little over 3% this morning. So I'm curious to see what the commentary is.
Yeah, and it's also worth noting, obviously, this degree of this drop here, I agree with you, it is a bit surprising. We're going to hear a little bit more in the call. But remember, though, this is a stock that has had a massive run up over the last 6 months, over the last year. Shares are up. They're down in the last 5 days, but when you take a look at the longer term chart, a 1 year chart, you're looking at gains of just about nearly 90%. So it's trading just below $17 a share, right around $16.55. So that run up here, although off of those depressed levels. So maybe some of this optimism already baked in to the price at this point. But again, the record-setting interest or record-booking levels that we are seeing from many of these, it's not just Carnival, many of its competitors also seeing those trends as well. So we'll see what more we learn on the call later this morning. All right, well, coming up, Moderna is entering a year of potential growth, pulling the company back from a post-pandemic lull. We will hear from the company's CEO on the other side of the break.
Moderna looking to rebound from its COVID slump. The pharma company announcing advancements in its Moderna and mRNA vaccine pipeline, along with unveiling positive phase 3 trial results for its next generation COVID-19 vaccine. Yahoo Finance health reporter Anjali Kemlani is here with us. Anjali, what did you learn in this interview?
Well, it's interesting because Moderna we know as just the COVID-19 company, but it's entering a year of potential growth, pulling the company back from that post-pandemic lull that we saw last year. And that's why CEO Stéphane Bancel announced these new initiatives, the new vaccine updates at their annual Vaccines Day today. The company's also looking to boost its global presence with a $1 billion investment in mRNA manufacturing in China. And we know that's an important area. Large market cap firms play in. But recent efforts by Congress to ban Chinese biotech companies has been creating a little bit of tension in the industry. It seems like this tension is not spilling over for Bancel. He told Yahoo Finance earlier today that he is not worried. Here's what he had to say.
I think there's a very strong agreement at the highest level between the US government and China government that they want to collaborate on healthcare, on the climate, and on food insecurity. Those are the three topics where at the highest level they want to collaborate. We want to help people and to protect people. That's what the company has been set up for. With all those vaccines in respiratory and in latent, we want as many people in the world to be able to benefit from those products so that we prevent disease.
So potentially carve-outs there for the company. Meanwhile, Moderna is also focused on ramping up its research and development. That's an area it has to be dedicated to continue that growth. It recently got a $750 million infusion from Blackstone Life Sciences for its flu program, and that's the initial thing that Moderna had been working on before it diverted to COVID. It's also advancing several candidates in its pipeline that would boost off-season business despite cutbacks on manufacturing last year. One of its biggest partners there was Catalent, and they are now being acquired by Novo Nordisk. So I asked myself if that's going to change anything or affect the company. Here's what he said.
The purchase of Catalent by Novo Nordisk did not affect anything for us because actually we were moving out of Catalent, the Indiana site, which is the one considered there as part of our planning for 24. What is important is the latent virus are not produced during the season. So if you think about Moderna, today our manufacturing is not as efficient as it should be because we make COVID for the season, but let's say in Q1, we don't make much product. We make clinical trial lots for all the clinical trial studies, but we don't make commercial product in our factory. So all those latent virus, as they launch, we can make them in Q1 or Q2 ahead of the season and have a much better utilization, and our cost of goods will improve a lot as we launch those products. So we don't need to add manufacturing, we don't need to add CapEx. So it's a great news in terms of our efficiencies and the return on equity we can create.
So it looks like that worked out for the company at least, but we'll have to see how these vaccines progress in the pipeline and wait till they actually get to market.
We certainly will. And Moderna, a name we're going to keep our eye on. And while we have you, we also want to take a look at another name that's within your coverage space right now, and it's Merck. A huge win here for the pharma giant. The FDA, the Food and Drug Administration, just approved its drug to treat a rare lung condition. Anjali Kamlani is still with us here. Anjali, let's talk about what exactly this could maybe potentially do to Merck's bottom line.
This is something that investors have been anxiously waiting on, and it could actually boost the bottom line. The company really needing a win as its blockbuster now, Keytruda, loses its patent in 2028. So this will fill the hole, and that's what investors have to say. Looking at what this drug does, it does help with a rare lung disease, like you said, and helps to reduce the risk by about 84% of death, as well as worsening events. The dosing is every 3 weeks, and it looks like about $242,000 per year for each patient. Meanwhile, like I mentioned, is going to be filling that whole. Revenue for this year alone could be about $400 million, according to analysts, with a patient population of about 40,000. So that's why it's a rare group, but a potentially meaningful group for the company to look at. It's not as big as cancer, obviously, but it does have that pull for the company. And that's why analysts like JPM analysts today saying, quote, more broadly, we continue to view Merck as having one of the cleanest paths to upside, both both near and long term in that large cap area. That's an area we know we've seen all these other large cap companies, really struggling with their LOEs, that loss of patents for some of their major blockbusters. So here it looks like Merck is going to be great. And a point to note, the drug did not have any, caveats essentially carved out by the FDA, even though there were some concerns that there could be based on some adverse events earlier on. So it looks like Merck really got that clean slate and can just kind of jump ahead.
And all of that news, by the way, lifting up the healthcare sector today, looks like it's up about 0.7% so far today. So all good news. Anjali, thank you so much. Really appreciate it as always, and great interview. Thank you for bringing us that. Coming up, we're going to have the Corcoran Group founder and real estate mogul, Barbara Corcoran, joining us live in studio. That's coming up after the break. Wall Street's bearish tone on Tesla continuing this morning. Citi is the latest to cut its price target on the stock to $196 from $224. Analyst Itay Michaeli saying that there is just not much upside potential for the company moving forward. And this is just the latest in a slew of price cuts and downgrades for the company. Yahoo Finance's Inez Ferry is here to help us put it all together. Inez, what do you got for us?
Yeah, Madison, and we are taking a look right now at Tesla. I just want to show you a year-to-date chart, and this is part of the reason why analysts have become more bearish on the stock or lowering their price target on the stock. Year-to-date, the stock is down 28%, over the past year, you can see it's down from these June levels, a steady decline here. Now, as you had mentioned, Citi analysts down, lowering their price target on the stock. You also had Bernstein analysts lowering their price target to 120 from 150 this week, maintaining an underperform rating on the stock. And then you had Mizuho analysts also lowering their price target on the stock from 195 from 270 and downgrading the stock to neutral. The analysts wrote that they're constructive on the long-term electrification trend, but near-term EV demand and tightening liquidity are creating challenges into 2025. Look, there are some analysts that have been lowering their expectations for delivery for the first quarter, and also they've been lowering their earnings guidance for the full year 2024. In fact, the consensus estimate from analysts is that earnings this year will be 7% lower than last year's. This is one of those stocks, the Magnificent Seven stocks, one of the least favorite, I should say, of those Magnificent Seven, guys.
All right, Inez Ferre, thank you so much for joining us. We really appreciate it. Now, coming up live from the New York Auto Show, Yahoo Finance is going to speak with Nissan America's chairperson. After the automaker's sales dropped last year, the big question, can EVs bring the spark back? That's coming up next.
We are watching shares of Coinbase off just about 1.5% after a judge ruled to allow the SEC's lawsuit against a crypto exchange to go forward. Now the judge saying Coinbase engages in the, quote, unregistered sale and offer of securities under U.S. law. Joining us now is our very own Jennifer Schongberger for the latest on this. Jennifer.
Hi, Shauna. That's right. A judge in the Southern District of New York ruling this morning that Coinbase engaged in unregistered sales of securities, allowing the SEC's lawsuit to continue moving forward. The judge ruled that Coinbase operates as an exchange, a broker, and a clearing agency for the purposes of federal securities laws. Recall the SEC sued Coinbase last year, saying that it violated federal securities laws based on the fact that it was engaging in securities. It also argued that Coinbase Wallet acted as an unregistered brokerage. We are hearing from Coinbase's chief legal officer, Paul Grewal, who is tweeting right now saying that, quote, today the court decided that our SEC case will move forward on most of the claims, but dismissed the claims against Coinbase Wallet. We were prepared for this, and we look forward to uncovering more about the SEC's internal views and discussions on crypto regulation. Looking ahead, we remain confident in our legal arguments. Shares of Coinbase, of course, are dropping on this news. We will continue looking into this and what the ramifications mean for the U.S.'s largest crypto exchange going forward. Shauna?
All right, Jennifer, thank you so much. We really appreciate you joining us on that developing news. We're also watching some additional news here. Reddit shares fall now over 13%, nearing 14% here in the trade. That comes as research firm Hedgeye added the social network as a new short idea in a recent report. Reddit shares had previously gained nearly 100% after last week's initial public offering. Joining us now to discuss, our very own Josh Schaefer. Josh, what was in this Hedgeye report?
Yeah, so I'm taking a look at this Hedgeye report here, and overall, it seems like largely a valuation call and just simply the rally we've seen in Reddit shares over the past couple of days, maybe being a little bit much for this newly issued company. Hedgeye had sort of put Reddit on their, they call it a short bench, coming into the IPO, and they were curious to see where the stock would go. They now say, given this rally that Maddie just referenced over the past couple of days, it's entered meme stock territory. When they wrote this report, it was at $65 per share. They called that overvalued. They said they see 50% downside in its original IPO price. And some of the key points they highlight here, they call Reddit a niche platform. And they say that it will not have a long-standing reach into potentially international markets, part of that being that Reddit relies largely on English. And then interesting in here as well, just looking at the valuation for Reddit, when you're taking a look at it at $75 per share, there's a chart in this Hedgeye report that puts it as the most valued, most highly valued internet or media stock in their coverage. That would be above stocks like Netflix, above stocks like Pinterest, even Snapchat, sort of the stocks that are in that Reddit realm. They're basically saying the valuation they feel like got a little bit too high here. And then you add in, I think, the long list of questions that a lot of investors have, given that the company just came public, on the overall growth trajectory. Just saying when you put that together, we probably need to see a little bit more here. And overall, it seems like even if they were to get some of the high-end parts of the growth metrics that Reddit has released, Hedgeye just doesn't think they can quite make it there.
Yeah, it's a very bullish, very bearish call out here from Hedgeye. I'm so used to everyone being so bullish about things these days, so the market's not too far from all-time highs. But Hedgeye clearly very bearish on Reddit here at this point. What stuck out to me was what you just referenced there, what they see in the second half of this year, what they see in the first half of 2025, that 50% downside to the original IPO price. Josh, how do you square that to the conversations that you were having yesterday when we were talking about the frenzy that has been surrounding many of these stocks that are now categorized as meme plays, and how that really tells us, or what that really tells us about where we are in this market cycle?
Well, so yesterday we laid out from our friend Steve Sosnick 3 keys to being a meme stock, right? One is you have a very passionate fan base following, which we know Reddit has, right? Another would be sort of the rally that we see in the stock, maybe detached from fundamentals, which we referenced we had it. Now we have short interests. So we can call Reddit a meme stock now. We just checked off our third box. But I think overall, yes, this is some of the sentiment you're starting to see among several of these names that we have on the board here. You have Reddit up there, you have the Trump Media Company up there, GameStop actually falling, largely on fundamentals today maybe, so maybe that's actually making a normal move. but Reddit and Trump media sort of working together there. And again, just moves we're seeing detached from fundamentals right now. Yeah. So certainly not surprising to me to see someone come out with a short call on this stock right now. Again, we just don't know enough. We haven't even had their first earnings report since they've been a public company, right? We don't have enough information here to see this valuation keep creeping higher. I think that's sort of a fair stance to be at with Reddit right now. Whether it grows in the future, up for debate, but for right now, it was quite the rally for the first couple of days of trading.
Yeah, it's interesting. I mean, none of my friends use it, which is my favorite indicator. If no one I know is using it, then not that means
we gotta get you
anything.
Hi, Maddie, we gotta get you on a different
30.
sector of the internet.
I know, it literally doesn't matter anymore because I'm not young.
You're saving a lot of your time by not being now, I'll tell you that much.
But always great. Thank you so much, Josh, for joining us on that news as it's developing here. Coming up, we've got a big interview. The Corcoran Group founder and real estate mogul Barbara Corcoran joining us live in studio. That's coming up after the break.
Disruption in real estate. Well, the landmark legal settlement between the NAR and several major real estate brokers having ripple effects across the industry. Now, real estate stocks sold off in the wake of the announcement. We have Zillow off more than 10% since the settlement was announced. Redfin and Compass shares, they have also declined on that news. Well, Wall Street is now trying to gauge, and Americans are really trying to gauge what the settlement will mean for home buyers, what it means for some of the major players within this sector. Who better to talk to about this than Barbara Corcoran? She's joining us now at the desk, founder of the Corcoran Group. Barbara, it's great to see you.
Thank you very much.
So let's talk about this settlement, just your initial reaction to it, the disruption. Will it cause disruption throughout the industry?
I think a lot less than people expect it to. But what it is causing is total confusion. Brokers are confused, buyers and sellers are confused. I even think the people who made the amendments are confused. But they're really only basically two changes that do make a difference. Not a tremendous difference, but a clear difference. One is if you're a buyer in the market and you want to hire a broker to represent you to find you a house, it now has to be in writing exactly what they're going to do for you and exactly what each service is going to charge. Okay, what they will charge you for each service. So there's clarity, and I think that's very good for the buyers that they have clarity. But it's not so good for the buyers because if the seller doesn't want to pay, like days of old, sandwich it into the commission, they have to take it out of their pocket. And buyers, I know, don't like to pay for things out of their own pocket. Okay.
I wonder too if sellers are going to find other ways to increase fees so that it doesn't necessarily lead to, or brokers rather, are going to find a way to increase fees and commissions so that there's not that big of an impact.
I think that's going to happen. I think particularly the sellers will step up to the plate because you have to remember sellers want buyers coming in. The more buyers that come in the house, the better the price they get, basically. So they're going to find a way to make good with the buyers, whether it be paying for closing costs or any myriad of things that they can do. But it will even the score out. So I don't think the ruling is a big deal, honestly. But the confusion it's causing is amazing.
So Barbara, you mentioned confusion, and I think a lot of people are confused, me included, about what this is going to do to the price of homes, right? Because you have the argument out there that if you're not paying for a fee here, an agent fee, then it makes more sense for the home seller. Maybe they could list their house, their home a little bit more. Maybe they'll list it less because they're not having to deal with those fees. Then you also have the other side of the argument where this could actually attract more people into potentially buying a home and get them off the sidelines here if we do see a drop in fees. What's the ultimate impact on home prices?
I don't really believe either of those things are going to happen. It's a neutral. Think of yourself. If you're selling your home and if let's say you save 3% with the new ruling and say, I don't want to pay the buyer's broker the extra 3%, do you think you're going to pass that along to the buyer, which a lot of people are saying is the case? No, sellers are greedy. It's a one-time chance to get the most for your house, and you're not going to give that money away. So if you think prices are going to come down, definitely not the case. There is such a shortage of houses right now that prices have gone up despite everybody singing the blues. 9% this year. 6% this year. How did that happen? It happened simply because of supply and demand. There's a lot of buyers and not enough houses to be available, and that's what rules the market.
Do you see prices continuing that move to the upside?
I think the prices are going to go through the roof, especially if interest rates come down another point by year end. I think everybody and their mother and their in-laws is going to come out looking for a new house, and the competition is going to be so fierce that house prices will have to go up.
So when should people be buying?
Right now. But that's always my mantra. Always the best time to buy. Not because I'm an ex-real estate broker by any means, but I'm sure I'm biased in my attitude toward it. But it always is true that the minute you go out in the marketplace, when everybody else is out, you always pay more. Why would you wait for that?
Barbara, a real driver here when we talk about the pricing of homes, why they have risen so dramatically has been because of inventory, that lack of inventory.
Definitely.
There has been lots of questions about what it's going to take in order to unlock more inventory, what the ultimate impact is going to be on the housing market. Do you see the inventory picture getting fundamentally better anytime soon?
It's gotten a little bit better, maybe to the tune of 4% more inventory a month in the last 3 months. But no, there's such a shortage of houses. I don't see how that's going to change. You know, the biggest problem, again, is interest rates. People who own homes have 3%, 4%, some of them even 2% mortgages. They don't want to give those up. That's why you have the bottleneck right now. That's why people aren't leaving their homes.
Is it still true that you can buy the house and then date the rate and you can refinance? Is that true in kind of a higher for longer environment?
You can, but it makes people feel good more than it makes a difference.
Okay.
Barbara, your advice to maybe people who are sitting on the sidelines, they haven't listed their home. They're a little bit nervous given the fact that we've seen that dramatic run up in rates. What do you think is going to be the key factor to prompt them? Is it mortgage rates below 6%? Or do you think even some improvement from where we've plateaued just below 7% is enough to move some of that inventory?
If it goes to 6%, people are going to get so much more for their houses. Why would they even think of selling? If it hovers somewhere in the 7%, the market is going to be so active and they're going to get more for their houses too. So it's a hard argument to convince a seller now's the time to sell. Life changes make it necessary for people to sell. But when it's optional, nobody's putting their house on the market.
I'm curious about your advice for first-time home buyers, obviously impacted by this settlement, but also a lot of people have just said, I'm going to give up. I'm just going to rent forever. Should people still have the goal of owning a home someday?
Well, first I'll say that rents are cheaper anywhere in the United States than buying. So logic would dictate, sure, why not rent? It's cheaper. But everybody, almost everybody, has this idea that the American dream is still owning your own home. But for the first-time buyer, they're the hardest hit. They have to compete the hardest, have the least amount of cash to compete, so they're not making cash offers, and they're losing 4 to 5 houses that they're interested in. I would not want to be a first-time buyer. I don't know what's really going to give there, but it's not going to be easy.
Any advice then for the first-time buyer? Barbara, help me.
I must sound depressing today, don't I? Yes, here's good advice. Do what I did for the last 4 houses. Now, people might say, well, I don't have her money. That's true. But I've done this my whole life. run into a community, see which houses you like, and leave love notes on every door.
And that's worked.
Yeah, you're allowed to leave notes. I love your house. It reminds me of my grandmother's house where I grew up in. The wallpaper, I noticed, or the garden, or whatever. Trim it up. Leave them a note. The last 4 houses I built were not on the that I bought were not on the market. I just picked out the house I liked best, and eventually the people called.
That's some great advice.
I love that
Might
advice.
take it, yeah.
I think sellers are going to kill us. They're going to get a lot of notes.
Hey, they're love notes.
Okay.
You can't be too unhappy. Barbara, thank you so much.
My pleasure.
Really appreciate you joining us. And
Hope I
coming into
wasn't
the
too
studio.
negative today.
Hey, you got the pink.
You're a
We're very
realist.
happy. Yes,
Okay.
exactly. Thank you so much. We
You're welcome.
appreciate it. We're going to send it back to our very own Praz Subramanian, who is live at the New York Auto Show.
Hey, thanks, Maddie. Yeah, we're here at the Nissan stand, the brand new global premiere of the Nissan Kicks, a very popular brand for the car. Nissan America's chairman, Jeremy Pepin, joins me now to discuss. So let's talk about the Kicks, an important car for the brand. What's going to set it apart, you think, in the market?
I think just look at this amazing design, right? I mean, that's the key, the key attraction when you see it. Obviously, we've also put more technology in the connectivity is improved. It's an all-wheel drive. This is first Kicks that's all-wheel drive, which means all of the northern states. Obviously, we have the technology that matters, and we're bringing in driving assistance capabilities that were not in the first generation Kick. So I think this one comes with the right level of technology, a great design, and we're still aiming for very attainable price points, which is really what the market wants at the moment. Good miles per gallon, affordable price points, and a lot of technology.
It's noteworthy you mentioned miles per gallon because, we were in the midst of a big EV transition. That sort of, I don't know if it's on pause, it's sort of slowing here. Nissan has a new sort of strategy with that globally, but also in the US, their midterm plan. How is that, how have things changed? I know fewer EVs, more gas-powered cars coming up?
I think our policy is to just move, the market will move with what the consumer wants. So we just want to, offer the consumer as much choice as he can, and then they choose the powertrain that's right for them. And so over the next 3 years, the company will be launching 30 new cars. In the US, 7. Within those 7, we will have all powertrains. We will have combustion engines, we will have battery EVs, plug-in hybrids, and hybrid. And so with that breadth of lineup, obviously the consumer has the choice of deciding at what speed each of one of them wants to move towards electrification. What is true is that consideration for electrification continues to grow. Satisfaction for those who drive an EV is very high, and so the repeat sale is there. So we see constant growth in EVs coming forward.
I know that globally, I believe 30 new cars by 2026, 16 of those EVs, which is a bit, I think, fewer than what you guys originally planned for. And also want to achieve ICE parity with EVs, or EV parity with ICE by 2030. Is that achievable? Is that a long-term goal that can happen?
I think it's achievable because, again, as we start to think again about how to conceive EVs, you just bring simplification in it. You bring greater commonality across many of the models. You have fewer parts per car, and the combination of both drives the cost efficiency. So yeah, we're thinking the next generation will see costs down by 30%. All of this, most of it, really to the consumer's benefit in terms of making sure we live up to our purpose, which is to offer vehicles to as many and as large of a consumer base as we can at Nissan.
Yeah, vehicles like the Kicks, and also with vehicles like Infiniti offering a broader range of products here. Nissan, of course, has big presence in the U.S., manufacturing presence here, but also you guys ship from abroad. We've seen what happens in Baltimore right now with the port being shut down and with that bridge situation. Is Nissan impacted at all by that Baltimore situation?
Yeah, first of all, my thoughts go through, obviously the families, the colleagues, the friends of the victims of this terrible accident. We've been happy users as a business of the Baltimore port. We've redirected ships to other ports on the east side of the country, and I think there will be no interruption to our business in the short term, and we're looking forward to working again out of Baltimore whenever the port will be ready.
So no impact there with what's going on with Baltimore.
No.
But big picture in the Americas, or in the U.S. at least. What is your sort of, kind of high-level view of the market, of the broader auto market in this country?
I think the market is fairly strong. It's around 16 million units at a high level. There was pent-up demand. A lot of that has been eaten up by where the interest rates have taken monthly payments. But the industry is solid. The consumer is in need of cars. Driving population has expanded, and people who have a driving license want a car. And so we should be positive and optimistic about the market going forward. We're surely very optimistic about our business because we have so much product announcements. You've mentioned Kicks, you've mentioned the Infiniti QX80, both models coming into high growth markets of the segments of the markets, the more entry SUV or the premium market. We'll have 2 more very new cars later this year at Nissan, and then another 3 over the next few years. So a lot of momentum. So we feel we're confident about the strength of the market, and we're very confident about our market share gains.
So Nissan's optimistic. Other brands have told me the same thing. They're optimistic with what's happening in 2024. High rates, forget about that. We're still sell cars. Jeremy Papin, thank you so much for joining us. Back over to you, Shauna.
Thank you.
All right, Praz, great stuff. We look forward to the rest of your interviews coming up later today right here on Yahoo Finance. Let's do a quick check of the markets. 90 minutes into the trading day. You're looking at a mixed picture, actually, with the Nasdaq now just below the flat line. You've got the Dow and the S&P moving to the upside.
And you're still seeing the tech names in the red here, but Apple and Amazon staying in the green and looking like we're going to be in a green day here. We're going to have our new show, Wealth, dedicated to all your personal finance needs coming up. Brad Smith has you for the next hour. Stay tuned.
Wealth, earning it, growing it, and managing it. It's more than tracking just the latest market moves. It's more than your favorite trending tickers. One does not simply build wealth without considering the entire financial landscape. It takes a community, and we've built one for you. On today's show, we discuss why you're better off ignoring some tax advice this filing season, and personal finance for parents, why custodial accounts might work for your loved ones. Plus, don't pump the brakes, why usage-based car insurance could be the right move for you. Welcome to Wealth. I'm Brad Smith, and this is Yahoo Finance's newest guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Let's get this bread. Your wealth theme for today, financial foundations, from planning for education costs to managing your taxes and expanding your financial literacy as well. We're diving into some of the key building blocks for success. Taxpayers, beware of unreliable advice this filing season. We're nearly 2 weeks away from tax deadline day. And with April 15th fast approaching, many people will turn to platforms like TikTok for the last-minute tips on taxes. But how do you determine what information is most reliable and applicable for you? Like when you see a viral TikTok post telling Americans to stop paying taxes by illegally exempting themselves from tax withholdings. That's just one instance. What do we even mean by all of this? For more on how to validate reliable versus unreliable tax advice, I'm joined by Greg Kling, who is the USC Marshall School of Business Associate Professor of the Practice of Accounting. Greg, great to have you here with us. Let's kick this off first and foremost with the number one identifier, perhaps, that people can look for when they are on social media and seeing a lot of these tax tips flow around this time of the year.
Well, first of all, thank you for having me this morning. Always a pleasure. You know, it might sound a little bit of a cliche, but I think the number one identifier is if it sounds too good to be true, it probably is. And by that, I mean, I don't want to just put skepticism out there. There are a lot of good tax planning strategies, but unfortunately, a lot of the misinformation out there is just downright wrong.
And so, of the information that you've seen flowing around, what are some of the common, perhaps, or most repeated tips that have been really permeating throughout social media, and where some of the users should beware?
Well, I think we can broadly put them into two categories. So the first one is, and by the way, this one is not new. It's what we call the tax protester arguments. And it really just centers around the belief that taxes are not allowed in the United States, and so I don't need to pay taxes. And again, we call those folks the tax protesters. That's just flat out wrong. Without going into the weeds on this, income taxation is here in the United States, both on a federal level and for many of the states. So that's just flat out wrong. You need to pay your income taxes.
Greg.
I'd say the other broad group is, I'll call it the influencer advice, which is you're an influencer, you go on vacation, you buy clothing and also, travel, meals, hotels, and you put up on TikTok or some other platform, I'm an influencer, I can deduct all of my expenses and get my income down to zero. Again, that's just flat out wrong as well.
Greg, context matters. You know this, I know this, and a lot of people filing, they know this as well, because there's certainly so many different forms that they have to fill out, so many different pieces of paperwork that they have to pull together to ensure that the government gets the full context of what their last year has entailed here. So I believe, even as we're thinking about some of the top profiles, sure, we've talked about the ones to be aware of, but are there top profiles that you've seen out there that maybe you even follow from time to time?
I would say for me specifically, I don't, and that's only because of the space I'm in. I mean, being a teacher, needing to stay up on the tax law on my own, I also do updates for CPAs and other tax preparers. So candidly speaking, I don't. And I think it's also, I'm just very weary of the misinformation out there. So yeah, I'm probably the guy in the group that if I want to find an answer, I will go look it up myself.
All right, Greg, we got to leave things there for today, but certainly great context to add to this conversation of where we're getting some of those tips and where we're also pulling in the professionals, the advisors out there as well. Greg Kling, who's the USC Marshall School of Business Associate Professor. Thank you so much for taking the time, Greg.
Thank you. Glad to be here.
Certainly. Well, coming up, did you invest in crypto last year? If your answer is yes, you're going to need to report that to Uncle Sam. We'll tell you how and why. Plus, financial planning. We put a poll in the field to see how many of our viewers financially plan for their future and how they do so. We'll bring you the answer later in the hour. Bitcoin euphoria is back, baby. The world's largest cryptocurrency is up more than 57% this year in 2024, but that also makes navigating the tax implications of crypto transactions more pressing as tax professionals worry about increased scrutiny. The IRS has announced it will hire 2 former crypto executives to support its digital currency service, reporting compliance and enforcement programs. So, here to make crypto filing easier for us is Yahoo Finance senior reporter Jennifer Schonberger to give us the latest. Hey, Jen.
Hey, Brad. If you bought or sold crypto last year, you'll need to report that to the IRS. Here are 3 things you need to know when it comes to filing your taxes and crypto. Number 1, you'll need to tell the IRS whether you received or sold crypto last year. At the very top of that 1040 individual tax form, the IRS will again ask whether during 2023 you received or sold a digital asset. Check yes or no depending on your answer. If you only owned crypto during 2023 and didn't sell it, you can check the no box. Of course, a digital asset includes cryptocurrencies like Bitcoin or Ether, stablecoins, and non-fungible tokens or NFTs. Number 2, for tax purposes, the IRS has determined that crypto should be treated like property and thus reported in many ways similar to stock sales. So, if you sold crypto last year with a gain, you will owe taxes on that. The tax rate is determined by how long you held the crypto. If you held for a year or less, that's considered a short-term gain and would be taxed at the same rate as your income. If you held crypto assets for more than a year before selling, then you would be taxed at the capital gains rate, which ranges from 0% to 15 or 20% depending on your income bracket. And number 3, if you sold your crypto investment at a loss, leverage that for tax purposes. You can use the loss to offset other income up to $3,000, $1,500 if married and filing separately to reduce your taxable income. And unlike stocks, investors can take advantage of the fact that wash sale rules do not apply to crypto right now. That is, with stocks, investors can't sell shares at a loss and then buy those shares back within 30 days and still claim that loss to offset other capital gains. But you can do that now with crypto. Now remember, this only applies to 2023 transactions, and if you bought and sold one of those spot Bitcoin exchange-traded products this year, that doesn't apply to this tax filing season. And by the way, the IRS has not issued guidance yet on those spot Bitcoin ETPs. And also one other note, if you received crypto as income last year, you'll need to report that as wages to the IRS. Brad?
Okay, Jennifer, so the IRS is also launching a new program to help first users file electronically and for free. What else do we know about this program?
Hey, Brad. Yeah, that's right. So the IRS, overseen by Treasury, has launched a pilot program in 12 straight states across our country, allowing Americans to file their taxes electronically directly with the IRS for free. The caveat here is that it is for very simplistic tax filing. So basically just those W-2s. Again, this is very much in a pilot stage. It's being funded through the Inflation Reduction Act. If this pilot program is to be expanded and to allow people with more complicated taxes to file directly for free, more funding would need to be allocated to this. Of course, this is something that firms like H&R Block are fighting vehemently.
Jennifer, thanks so much for tracking all the latest out of the IRS. Appreciate it. Thanks so much.
Thanks, Brad.
Well, a new study by Northwestern Mutual reveals 1/3 of Americans do not feel financially secure. That is a 5% jump from the prior year and the highest level of insecurity in this study's decade plus history. Over half of Americans cite inflation as the greatest obstacle to financial security. And to top it off, only 45% of U.S. adults consider themselves disciplined financial planners, a drop of 20% from 2020. Joining me on set to talk about financial planning and security is Brendan Copeland, the founder of Life 101 and CEO of athletes.org and author of the upcoming book, Your Money Playbook. Great to have you here on set with us. Thanks very much for taking the time.
Great to be here. I appreciate you having me.
Certainly. So we got to talk about this study because, I mean, it certainly seems in terms of financial planning, there is a lot of insecurity that people still have right now. As you think about it, and as you even help people with some of their life coaching and financial planning now too, what is step one that you tell them?
Yeah, first and foremost, you got to identify your why and create a budget, create a plan. You know, as a football player, an athlete, we went into every single week with a plan to stop Patrick Mahomes, a plan as much as you tried to stop Patrick Mahomes,
yeah.
right? But you had a plan, right? And I think that first and foremost, a lot of us go into this battle of reaching financial freedom without a plan. It's let me make as much money as possible. Let me get another job, right? But you haven't figured out where you could be losing money because you haven't gotten all your affairs in order. So first and foremost, creating a plan. I think after that, building up an emergency fund is huge, right? A lot of people talk about it, but having that safety net and that safety cushion gives you the ability to weather a storm, right? You can have all the plans in the world, but life happens, and then you can hurt yourself if you don't have that emergency fund built. Third, I would make sure you're paying off any bad debt, right? Prioritize it, hustle, and make sure that is off of your shoulders and not a burden to you for too much longer. And then at the end of the day, I always say you got to make money your employee. Put your money to work for you, or you'll always have to work for money. And so that's investing, that's retirement accounts, that's a number of different strategies, but you have to eventually become the bank and start to manage your money in a way where you are playing puppet master, so to speak, and trying to get returns on it.
No, that's great advice. And when you think about the NFL player on average versus those of us out here in the workforce, it's a different type of scale, but there's a lot of other costs that you factor in along the way as well. Walk us through that kind of that push and pull where you think about the earnings that you were able to have and how you go about stretching those over time as well.
Yeah, so I mean, specifically from an NFL player, as you mentioned, one, first world problems, we are able to be paid like a king, as some folks have said, to play a child sport. And so that's amazing. However, there are also a lot of costs and things that come with that. Whether, for me, I lived in 7 different places over 10 years, right? That's new leases, that's new apartments, that's new furniture.
From team to team.
From team to team,
about,
right?
Yeah.
It's part of the job, right? I also think that there's obviously a target on your back as well, too, where you get a lot of people coming after you who some mean well and have great intentions with your money, but some are salespeople, right? And they're hoping that you don't have focus on what they're doing with your money. So you have to bat that away. And then the final thing that I don't want to say hurts a lot of players, but a dynamic that people have to think about, and it's true for a lot of people, it's just we're under a microscope, so you see it more often, but we have family members and parents and really new family members. I got new cousins that I never even met or heard of.
Pop out of the woodworks.
Yeah, and they have stories, right? And you know, I've had random Venmo requests right now, and for people's tuition and books and things of that nature, which again, it pulls at your heartstrings, but you have to build up, all of us have to build up the ability to prioritize ourselves and say no.
Yeah. In that prioritization of self, it's interesting, you know, while we're talking about the earnings for athletes, what is, and there's that windfall kind of like right out of the gate. You get drafted and perhaps there's that first check, it clears, it hits the direct deposit. Yes. But then there are a lot of people who might make the worst financial mistake at that juncture. What is the worst financial decision that you ever made, and how is it a lesson for others?
Oh, so the worst financial decision I ever made was just being complacent. When I came into the NFL, I was day trading, and I would day trade every single day, and literally there'd be times I'd buy Nike call options, and I'd go into meetings and I'd look around and everybody's wearing Under Armour that day for some reason. I'm like, you know what, I need to sell out of this. Coach, I got to go to the bathroom, right? It's probably why I didn't start as great as I would have liked to start it in the NFL. But I think by having success day trading for my first year, I got to the point where I thought that it was natural. It was going to happen regardless. And by doing that, I took one of the biggest losses in my own career by trading Nike call options before the end of the year. And at that time, Greece, there were geopolitical tensions going on over in Greece, and the whole market was down, so didn't understand leverage and how to manage my risk appropriately. So that's my biggest financial mistake. I'm sure there's a number of others. I'm going to make more mistakes, newsflash, but that's what happens when you're trying. Steph Curry is still missing shots, but he's still taking them.
That's right, indeed. And then just lastly, while we have you, I mean, you talk about budgeting for the future beyond sports as well. There are a lot of injuries that athletes have to think about and how they maintain their body even after that time on the field or on the pitch or on the court after that ends. You know, how have you gone about doing that? Where do you even act as a support system for some of the other athletes out there and letting them know how you're going about it?
Yeah, I think, you know, when you are an athlete, your job is your body, right? That is your largest asset. And so you take care of it, you know, most of us take care of it with like extreme measure, whether that's what you're putting into it, that's how you're treating it, and the rehab and the prehab and all those things you do. And so for me, over the last my 10 years in the NFL, all of the rehab equipment I was purchasing, which in my mind, I was like, you know, I'll spend more money here to have this machine at home so that I can spend more time on it so that it may give me one extra game. Then it pays for itself. But now continuing to use that stuff, right? Like a lot of us, we get off the bandwagon, and I fell victim to that as well too. Got off the bandwagon, and for the first time in 24 years, I didn't have to work out. And in 10 years, I wasn't fined if I didn't show up to a workout, right? So I stopped working out. But you got to continue to take care of your biggest asset as if you're going to play again on Sunday, because it's going to pay off for you in the long run. So stacking up all that rehab equipment and making sure that you don't forget that you are an athlete, even if you're not suiting up for the Baltimore Ravens this week.
There is a health is wealth conversation and an entire segment and perhaps an entire show or week special within that. We got to leave it there for today, though.
Amen.
Brandon Copeland, founder of Life One-on-One and author. Check out the book there. We got it on screen. Upcoming book, Your Money Playbook. Thanks so much for taking the time and
Thank you for having me.
Appreciate it, definitely. Switching gears here, let's go to the credit card space. Yahoo Finance's executive editor Brian Sozzi spoke to Robinhood CEO Vlad Tenev earlier today about the company's new credit card and how they feel about playing in the same market with giants like Amex, Visa, and MasterCard. Here is what he had to say.
We didn't want to just come out with a Me Too product. We wanted to differentiate on rewards. We wanted to differentiate on user experience and, of course, the design. And I think we've been able to do that in all three categories. The rewards, I believe, are the best in the industry. Nothing can compare. The design and the user experience, the digital experience, I think we're very proud. The team is very proud of what we've built. We really have, you know, not just business people and technologists at Robinhood, but we have great artists too. And I think we've made what I believe is the most iconic card on the market.
And it's not just Robinhood. The credit card space getting a lot of attention this week as Visa and MasterCard reach a settlement with merchants over swipe fees in a legal case that's expected to save businesses $30 billion in fees. Let's bring in Yahoo Finance's Molly Moorhead to give us all the details on this. A landmark settlement, we should say, as well here.
The case has been dragging on for decades, and it settles the antitrust claims over businesses saying that Visa, MasterCard, and their partner banks are charging unfair fees. And this is the 2 to 4% transaction fee that businesses pay the credit cards every time we swipe our card in a transaction. And it should save money, in particular for small businesses, that it's harder for them to absorb that fee. But what we're going to be looking at is how this might potentially affect cardholders, right? Because in particular, rewards cards, which carry those really nice, valuable benefits and perks, typically have higher swipe fees. And so is this going to change that formula? Is it going to affect what kind of rewards are offered? That's what we're going to be watching.
Switching gears here from credit cards to insurance as well. Auto insurance rates, I mean, it feels like they're spiraling all over the country, up 20% year over year. We want to show you one way that you could potentially lower your payments, and it involves selecting a different type of insurance. What is this different kind of insurance, and how does it work?
So it's called usage-based insurance, and there's kind of two different types. One is pay per mile, and so you pay a base rate, and then you pay per mile you drive every year. And it's really only for people who drive 10 to 12,000 miles a year. So commuters, people who drive a lot, not a great option. But it can save money for people who just don't have to drive that much but need insurance. The other one that's gaining popularity is pay how you drive insurance. And this uses technology in your car to track your driving habits. And that's how your rates are set.
So it's tracking how many red lights I run, things like that. Okay, all right. So what kind of driving habits would these programs track? You know, all jokes aside.
Yeah, it gets very specific. So they can see your acceleration rate, how you brake. Are you slamming on the brakes a lot? And another key one, are you on your phone while you're driving?
Wow.
That's what they're watching.
And so what are the pros and cons of usage-based, UBI, usage-based insurance programs?
The big potential pro is money saving, and that's a big deal right now. As you said, car insurance is so high. The major insurers say that the potential savings here is 15 to 30% on your premiums, and so that's the big plus. The con is privacy, right? You're letting them put a device in your car that is following you around and watching everything you do, and that makes a lot of people uncomfortable, so there's a trade-off.
Yahoo Finance's own Molly Moorhead. Molly, thanks so much for breaking this down for us today.
Thanks for having me.
Coming up, everyone, we explore why you might not feel wealthy, especially if you're in your 40s. That is up next. Every day on Future Finances, we're looking at how your finances today can set you up for success for tomorrow. Today, we're looking at why you might not feel wealthy, especially if you're in your 40s. The quote, sandwich generation, they said it, not me, often financially supports both their children and elderly parents, putting a strain on their wallets. And it's not only that age group feeling the squeeze. As of 2023, only 14% of Americans believe that they are wealthy, according to Edelman Financial Engines. Well, why does that matter? Just the perception of wealth can impact your stress, your emotional burden, and how you ultimately handle your money. To break down how you can set yourself up for success and feel richer, Andy Smith, Edelman Financial Engines Financial Planning Executive Director, is here. If I don't feel richer after this segment, Andy, I tell you what, I'm getting up, I'm walking off set. What is one of the basic ways that people can begin to feel wealthier?
Well, I think it kind of is an issue about figuring out how you feel about money, right? So when you think about what it takes to get kids through school, when you think about what it takes to pay off a house, when you think about what it takes to get to and through retirement, you have this particular number in mind. Well, what we found in this study that we did, it was called Everyday Wealth in America, we found that like 67% of Americans feel that they need about $1 million or more to feel wealthy. But we pressed a little bit further and we said, all right, this is what it takes to feel wealthy. What about what's it going to take to feel worry-free? And people said that they need about $284,000 more to get to that next level. But what we found was that it kind of differs based on where you are. So if you're in your 20s and 30s, you're thinking and feeling and focused on one thing. If you're in your golden years, if you're in your 60s and beyond, right, you've got the kids through school, your financial responsibilities might be a little bit less. Hopefully your kids are financially, stable and you're not dealing with them as much as in the past. But you talked about that sandwich generation. That's the issue. And so people in your 40s, think about what you're dealing with, right? You're stuck in the middle. You're taking care of kids. You're taking care of potentially elderly parents, but you're still dealing with all of your stuff. You're still trying to save and prepare for retirement. You're still trying to take care of your own mortgage. You're still trying to take care of maybe your student loan debt. So you're laying awake at 3 o'clock in the morning, staring at the ceiling, trying to figure out how to make all this work. You're going back to those numbers. And if you're not there, that's where the real pressures start to come.
And so we talked about some of those stressors. Where then does the sandwich generation or really anyone that's trying to feel wealthier and perhaps combat the real figures that they've identified as hurdles that they have to get over, where have they then said, okay, I'm going to tap more into perhaps the gig economy, or I'm going to pick up a side hustle? Where does it seem like a lot of the thinking goes from there?
When I talk to clients, there's kind of two big levers that control a lot of cash flow plans and a lot of retirement plans. One lever is basically how much money do you need, right? What does it cost you to live on a regular basis? Do you have bigger expenses coming up? The other lever is when do you need that money? So if you notice, it might not always be what do you have coming in? Do you need to take on more work? Do you need side gigs? Do you need side hustles? Do you need to sell plasma for soup, right? It's not all of those things together. What we're trying to focus on, what anybody should really have a sense of, is you got to run to the problem. You got to figure out what that number is that you need to hit. And then you kind of work backwards. Right? You work with somebody who's not necessarily trying to sell you something, but is trying to work through this plan and figure out, look, this is where you are, right? You're in your 40s, you're freaked out about money, you're trying to figure out how to deal with mom and dad, you're trying to figure out how to deal with teenagers and college kids, you're trying to figure out how to deal with your own stuff. You run to the problem, you start to identify very specific goals. When do I want to retire? How much do I need? What do my parents need? What do my kids need? And then what happens is you start setting up all of these different sorts of goals within a cash flow plan. And what we found, we talked about that Everyday Wealth in America study. 67% of people think they need $1 million or more to feel wealthy. Well, we also asked them, all right, what would it take to start to feel a little bit better? What would it take to start to relieve some stresses? as it relates to your finances. Well, only 37% of the people that we talk to report working with some sort of financial advisor, working with some sort of financial planner. So you have less than 40% working with a professional to get help with all of this stuff. But of that group, 76% of that group, of those people working with planners, reported feeling less stress, reported, feeling like they have some sense of a go-forward plan,
right,
so that they can get all the way through this. So I think it comes down to working with somebody, working with a fiduciary, somebody who's duty-bound to put your best interests before theirs, so that when you finally kind of run towards these problems and you're needing this help, they're not trying to sell you some 7 magical stocks and they're going on to the next mark. They really are trying to address your issues and help you feel a lot better about the money in front of you.
All right. All good tips here. Andy, thanks so much for taking the time. Andy Smith, Edelman Financial Engines Financial Planning Executive Director. Good to see you.
Brad, thanks.
Thanks. Well, it is an election year, and we're already being bombarded with talking points and promises that may or may not pan out. The latest, Republicans released a 2025 spending proposal with, quote, modest adjustments to the retirement age. To break this down and what it could mean for your retirement, Yahoo Finance reporter Rick Newman is here. Hey, Rick.
Hey. Yeah, so President Biden attacked this right away, calling it an extreme idea and saying basically they just want to wreck Social Security. We kind of get this every election year. Republicans say they have plans for how to reform Social Security. Democrats say they're going to take Social Security away. It's a lot of fear mongering. People need to know you can't change Social Security unless Congress passes a law. So no one's going to do this on the sly. But look, Social Security is going to start running short of money within about 10 years on current projections. And Medicare, the health program for seniors, is going to start running short of money probably a couple years sooner than that. They're not going to run out of money completely, but if nothing changes, they're not going to be able to pay all benefits in full. So, this is one of the big problems everybody in Washington has known is coming. The date fluctuates a little bit based on the state of the economy and stuff. But at some point, we're going to have to make changes to Social Security and Medicare. And almost assuredly, it is going to involve some combination of tax hikes, which is how President Biden wants to solve the problem, and modest changes in benefits. And that is probably going to include a gradual increase in the eligibility age, which, by the way, we've done before. In a 1983 law, the eligibility age for full Social Security benefits used to be 65. A 1983 law changed that to 67, but that went into place gradually over a span of 30 years. So, it's very plausible we're going to see something like that again. But nobody should panic because nobody's going to sneak a Mickey on you here. You're going to when we debate how to fix Social Security, people are going to know what's happening.
And more likely than not, if there is continued logjam, then the likelihood of any of those bills getting through and
they're going to fix this at the very last minute.
Yeah.
But we're going to be talking about it for a long time. So get your brain around the fact that we're going to have to do something here.
Rick, thanks so much for breaking this down for us. Yahoo Finance's own Rick Newman. Coming up, this one's for all the parents out there. Raising a kid costs a lot of money. But we're going to show you how one way that you could be able to ease some of those long-term costs could be effective for you. We've got more after the break. The joys of parenthood, every parent says, right? When most people think about having children, they think about bonding, bottles, bouncing babies on their knees, play dates, toys, all the fun, exciting parts of raising a child. One thing they might not take into consideration at the gate is the cost. According to Credit Karma, as of 2024, it could cost parents up to about $18,000 per year to raise a child, and education is one of the biggest yearly expenses. So, how can young parents begin easing some of those costs early on? One solution, 529 plan. Joining us now for our Simple Finances segment is Maconomics founder and personal finance expert, Ross Mack. Ross, I know you have children as well, so what are the 529 plans? You've looked into this. Take us into it.
Well, one, Brett, thanks for having me. And to your point, right, it is extremely expensive to raise a child. And I think one of the great testaments is finding a way to ensure your kids have the opportunities that you didn't have. And for me, I actually had student loans when I graduated college. And so now I'm being way more thoughtful when it comes to ensuring my kids don't actually have to have student loans. And the first thing I looked at was a 529. And so a 529 is a tax advantage college savings investment account. Right? I want you to think of it like a 401k. However, it's for future educational expenses. And the good thing is it's going to be tax advantage on the front end and the back end, where you're going to be able to potentially get, tax-free growth, and as long as you're using that for qualified educational expenses.
And so as a guy with 3 little ones, as we mentioned, what's one big expense that hit you the most that new parents may not think about?
Well, one, right, we clearly are living through extreme high inflation. And so groceries are pretty expensive, right? I had no idea how much formula was, as well as, childcare, right? We're talking daycare, we're talking nannies. Those things are pretty high. And so as I think for the future, I'm instantly thinking about, okay, college expenses as well.
Certainly. Ross, great to see you. Thanks for breaking down the 529 for us here today. Appreciate it.
Without a doubt. Thank you.
Well, Yahoo Finance put a poll in the field. We wanted to learn how U.S. adults are planning for their financial futures. And the results were a bit surprising here. 15% say they use a financial planner, but a whopping 71% say, hey, I'm just doing it on my own on the weekend, sitting on the couch. I got my Snuggie on. But we know that there are varying degrees of financial literacy. And the National Financial Educators Council has found that there is a steep cost for lacking financial literacy, about $1,500, $1,500 per person last year. Joining me now for more on financial literacy is Tyrone Ross, principal and founder of 401 Financial. Great to have you here in studio with us.
Yeah.
You say that we should actually be rebranding this as financial education. So how can we go about doing this?
Yeah, really passionate about that because I think financial literacy has a stigma. Right, that it's for the underserved of those people. When you bring in financial education, just marketing terms, right, it broadens the scope. I also think that when you talk about financial education, now you're talking how do we implement it early on, right, pre-K, kindergarten, so that it becomes a part of our lives every day, where financial literacy is, I got a job, I have a 401k, I have kids, now all of a sudden I have to figure out all of the pieces that was never given to me early on. So I think making it a part of an education structure very early, I think could change a lot of the damning trends that we're seeing with financial education and access in the country.
Certainly, from the piggy bank all the way up to the key paperwork that we need to know about as we do get older and get involved in purchasing homes, or as we were talking about a moment ago, financing educational costs here as well. When you think about the existing model in wealth management, a lot of people are trying to wrap their heads around when they need to bring in an advisor versus some of the results that we were just taking away from our poll recently in people doing it themselves.
Right.
How do you evaluate this?
So I was just looking at some of the wonderful stats that you all have here, right? When the stock market started back in 1871, I believe. Now let's just go back to that time.
Back to the buttonwood tree we're going
here.
here.
The buttonwood tree and Merrill Lynch and all those firms that are 100 plus years old. Imagine if those firms were started and it was Merrill Lynch Personal Finance and not Merrill Lynch Wealth Management. Because if we walk outside right now, everybody that walks by a wealth management firm goes, I'm not wealthy. I don't know what wealth is. So it's for those people, again, the rebranding. So I think what I see there in those stats are people who feel like financial advice is not for them. We need to make it more affordable, more accessible, and more personable and personalized so people feel like no matter where I am, right? Like estate planning. The estate is for those in Beverly Hills. No, if you have life insurance, you create an estate. So I just think we need to get closer to people, learn what their needs and concerns are and address them. And I think this show and other things like this are a great way to do that.
We all walk around with a smartphone, or some of us sleep next to it. That's on you. That's not on me.
I do. I'm guilty.
I mean, we all are at some point or another. It's my alarm clock anyway. But we've all got devices, access to technology. What are some of the top technological resources that you see people tapping into to create a plan and execute on the vision as well?
Great question. So I tell people this all the time. One of the things that your phone comes pre-installed with is the stock app, right? So I think that's the first way to just start to get familiar with tickers and stocks and news. That's the first thing. I think the second thing is there are a lot of wonderful apps down there. We can run down so many that folks use to just get a hold of what is it that I'm doing and when I'm doing it. I'm a big fan of the Apple brand, right? The Apple Card, Apple Cash, all that. Why? Because it shows you in real time everything that you're spending. You spend and you get an alert. Credit cards are set up that way as well. So there's plenty of tech, but I think the one thing that we think about at my firm and just in general is your device is going to be your accountant, your advisor, your lawyer, everything, because you can just pick it up and get real-time advice at any time. And I think that's powerful. So outside of everything, I think the phone is it. Your iPhone has become your financial life in your palm.
We've been connected on the socials for a while, and I've been able to see the content, the financial education that you're able to put out into the world. I was also able to see, though, that you were a pretty serious athlete back in the day as well here. An Olympic qualifier, if I remember correctly here. And there are a lot of athletes that also have to think about, okay, what does my financial planning look like after I'm generating my income that way? What was that realization like for you? How did you go about making that transition?
Wow. So for me, I don't want to say I'm a bad proxy, but I actually was working on Wall Street at the same time I was training, right? So I was getting a real life education in it. But knowing a lot of athletes that struggle with it, I think you're at the point where you're putting your all into this, you're developing your personal skills, your physical skills, but then you're forced to learn a whole nother life when it comes to money. And for me, and let's be very clear, track athletes do not make the money that some of these other gentlemen that was on here before. But I think what you have to learn is you can come to, my career was over right around 32, 33 years old. You got a lot of life left to live. And then you look up and go, all right, a lot of life, a little bit of money. How do I extend this? So I think I know a lot of professional athletes as well, is that, all right, here I am at the end of my career, could be earlier. And now the money that I had, I was kind of living like this money was going to happen, going to be around forever. I was always going to have it. So I think the transition of just, and I say this all the time, I wish there was someone that sat with these athletes day one when they signed the contract to say, it's the most money you've ever had in your life. Where are you going to play? I'm going to play in New Jersey. All right. Well, let's just say you live off $500,000, right? Can you do that? Just have that conversation with them, make it very easy, and then deal with all of the complexity later, because I think if they realize what it's like to have 200,000, 300,000, 400,000 and just live off of that, they can live a really nice life. And then you can start to have more in-depth conversations about investing in real estate and all these other things. But just simply sit them down and say, hey, this is what you need to live comfortably without all of the gaudiness. And then I think those real conversations, as the money really starts to come about, inject some type of financial education and planning. If I'm being, honest here, separate it from the agents, right? So that there's not the folks that are hanging on to them having the money, but people that can give objective advice.
And it seems like that's a thought that's permeating even more athletes who are saying, I'm just going to live off of the salary and then I'll spend the endorsements, yada, 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 whatever the mix is that makes sense for them. And I'd say that you're a pretty good proxy of budgeting your time in order to go through the Olympic training. Tyrone Ross, thanks so much for taking the time.
Thank you so much for having me.
Definitely. Coming up, everyone, actively managed ETFs are gaining traction in 2024. But what does that even mean for your money? Much more on wealth after the break. You're watching Yahoo Finance. Actively managed ETFs are gaining traction in 2024, but let's pause for a second and explain what that means. An actively managed ETF is an exchange-traded fund with a manager or team making decisions on the underlying investments in the fund, according to Investopedia. But what does that mean for your money? I'm glad you asked. A new survey from Verify found over 75% of advisors would consider small and mid caps when investing in actively managed ETFs. To break this down further, Todd Rosenbluth, Verify Head of Research, joins us now as part of the ETF report brought to you by Invesco QQQ. Great to have you here with us today, Todd. First and foremost here, when we think about making the decision of whether or not actively managed ETFs are right for individuals, what is the first thing that they should be considering?
Right. So actively managed ETFs, you have a professional manager or management team sorting through the universe of stocks, whether that's large, small caps, or international equities, to find the best investment opportunities from a valuation and fundamental perspective. So most ETFs and most of the ETF assets have historically been in the S&P 500, the Russell 2000 for small cap exposure, and that tracks a broad index. But with active management, you get the benefits of a professional. You were just talking about the benefits of having a professional involved to choose the individual companies that make it inside the portfolio.
Where do the holdings that we know right now largely index towards? Because there's going to be some very popular overcrowded ETFs perhaps out there based on themes. And those themes could range from anything from small, mid caps, AI perhaps even, and some thematic equity strategies. Where are you seeing kind of the overabundance of indexing?
So most of the ETF assets are concentrated in large cap equities, S&P 500 or the Russell 1000 based strategies, and iShares, Vanguard, and State Street offer it. But as you alluded to in the beginning, we're seeing actively managed equity ETFs punch above their weight. So about 5% of the overall ETF universe is actively managed equity ETFs in regard to overall equity space, but 25%, give or take, of the flows in 2024 have been there. So we at Verify identified a few small and mid-cap actively managed ETFs that we thought were warranted attention. So Avantis has a U.S. equity small cap ETF. The ticker is AFSC. That's one of the more popular of these actively managed small cap ETFs, broadly diversified, low cost structure. It has the benefits of quality and valuation incorporated within the overall portfolio. Dimensional Funds also offers a broadly diversified, actively managed ETF. And then there's a few other ones that maybe we can get to.
And just lastly, while we have you here, we only got about a minute left in the show, but as you think about comparing the performance profile of actively managed ETFs versus the broader market, how does someone use a good benchmark? What is a good benchmark to compare an actively managed ETF against just the performance that they would see if they were just buying the S&P 500?
Right. So we think for small caps, you should use either the Russell 2000 or the S&P 600 index, and a couple of the actively managed ETFs we wanted to highlight. Fidelity has a small cap ETF, FFSM, that has outperformed year to date the iShares S&P small cap index. The T. Rowe Price small and mid cap ETF, TMSL, that one has also outperformed. If you're looking at active equity ETFs, you want to use an index-based equity ETF in that same investment style to give you a good reference point. These are two proven managers that have had success out of the gate in 2024.
All right, Todd Rosenbluth, who is the Verify Head of Research. Todd, thanks so much for taking the time here with us today. Appreciate it.
Thank you.
Certainly. Well, we're wrapping up today's show. You can tune in at 11 a.m. Eastern Time tomorrow. Guess what? We're going to talk about how joint bank accounts, those JBAs, how they work, and when does it make sense to use them. And we'll dig into the stocks that are benefiting from revenge spending. Yeah, I'm talking to you out there, and kind of me too. Do they belong in your portfolio? Plus, we'll reveal why you should be maxing out your 401k. All that and more when Wealth returns tomorrow at 11 a.m. Eastern Time. That's it for now. I'm Brad Smith. Thanks for watching.